In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for, and why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality, and he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
2 p.m. on Wall Street. The equity market a little on the back foot today after the employment report for the month of May came in stronger than forecast, really pointing at the idea that the Fed is going to have to remain aggressive as it battles inflation. May non-farm payrolls up 390,000, the unemployment rate remaining unchanged at 3.6%. Jeffrey Rosenberg is a senior portfolio manager at BlackRock Financial Management.
To take a step back, 390,000. This is still a very, very strong and too strong labor market. So we need to see that slow. And, that's in the expectations, and you're getting a little bit of that, maybe a little bit of disappointment in terms of the slowing.
Now, even before today's report, the Fed was seen raising interest rates by 50 basis points at the next two policy meetings, June and July. And now, market-driven odds are calling for a third hike of that same magnitude in September. Probability of that happening is around 85% at the moment. There are 11 industry groups within the S&P. Only one positive today, energy, which is up about 1%. In the minus column, consumer discretionary, information technology, and communication services. We've got the S&P 500 down about 1.6%. In the NASDAQ market, the composite index weaker by more than 2.5%. Shares in Novavax being very hard hit today. Stock is down more than 20%. This is after U.S. regulators raised concern over the company's much-anticipated COVID-19 vaccine. Briefing documents released today by the FDA note some heart risk with this shot. Now, the FDA is going to meet next Tuesday with its advisors as the agency considers an emergency use authorization for that Novavax vaccine. In the bond market right now, 10-year Treasury up nearly 5 basis points in yield. We are at 2.95%, a 2-year at 2.65% with a gain of nearly 3 basis points. I'm Doug Krisner. That is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
TGIF, everybody. It is Friday, June 3rd, 2022. Jobs Friday. In fact, we're going to talk about that. We are live in our Bloomberg Interactive Broker studio. We are, streaming on YouTube, and I'm bouncing around a little bit, got a good night's sleep. Stocks bouncing around as well.
They are, after another strong jobs report ramps up expectations for more Fed rate hikes. This is a good news is bad news scenario. We're going to get to that in just a moment. Yeah. Also, Amazon.
Yeah, well, you flagged this story.
It's a big deal.
We had a plan. Our producer, Sarah Livesey, had a plan. And then she's like, what? Now I have to get an Amazon guest?
Yeah, talk to Dave Clark. It's his fault.
I know. Yeah, exactly. We're going to talk. This is a guy who's been at Amazon for a long time, but he's out the exit door. Unfortunate sign of the times also, and this is a serious story. I feel like it's been weighing on us the last month or so already. More mass shootings this week. Bloomberg Business Week reporting that the NRA lobbying is curbing research that can prevent violent gun deaths. So we're going to get into that.
We've also got this sector spotlight on airline stocks. They're taking a dive that's deeper than the broader trade. Today, we're going to talk to George Ferguson all about that.
Spotlight 2 on M&A, and then we're going to talk to Ben Armstrong, founder of BitBoy Crypto, talk about the recent market stress.
It's a Friday, so it means it's time for a drink.
Bottoms up, everybody.
Yeah, we're going to talk to Sovereign Brands. It's a family-owned wine and spirits company.
All right, first up, let's get to the market drivers report. Let's set the Business Week agenda on this Friday. Michael McKee, he's been at the Queen's Jubilee in the UK, which is why he's not in the studio with us.
No. I want to see his hat.
Do you do the tilt-a-hat, Mike? It feels like everybody's wearing a hat. It's like at a tilt, at an angle.
Every time I do that, I get in trouble. I get told my hat's at an angle. So I try to keep it straight. That depends on whether, as you say, it's Friday and you need a drink.
Don't we all after the last couple of weeks we've had? Michael McKee, he is via Zoom with us in New York City. Abigail Doolittle, though, she's markets reporter at Bloomberg News. She is in our Interactive Broker studio. And let's start with you. We're going to get to jobs in a moment. I do want to talk about, though, the volatility we're seeing once again in the market trade.
Yeah, we are seeing some decent volatility. Overnight, the futures had actually been higher, slightly ahead of that jobs report. Right now, the S&P 500 down 1.5%, the NASDAQ down more than 2%. And I would say it's really tied into that jobs report because it came in a little bit better than expected. Similar to the ISM manufacturing on Wednesday, good news appears to be bad news. and in a new way with a twist, because in the past, of course, that meant that the Fed was likely to accommodate less. Now it means that the Fed's likely to tighten more. And then you have the backdrop of Elon Musk talking about a super bad feeling about the economy. It was sort of just the perfect storm to put the S&P 500 on pace for a weekly loss as opposed to the weekly gain that we were looking at yesterday on the close.
David Dietz of PPAC, he's been a guest on our air, and he's kind of saying a trifecta. You had Jamie Dimon talk about the hurricane economy. You had Microsoft with the warning, even though Anurag kind of debunked that. And then you also had Tesla coming out and saying, like, all three of them, that things are not as good as they appear. So Michael McKee.
Or are they? I mean, because these are pretty strong numbers.
I know.
Well, I've been saying the kind of analysis that Abigail was talking about from people on Wall Street, I think is a little misguided in that it is putting too much weight on 1 month. When you look at what the Fed's talking about doing, they're talking about trying to bring inflation down from over 6% to 2%. That's going to take a lot of work. It's going to take a while. And as I said earlier today, the U.S. economy is huge. It's like a battleship. So it's going to take a long time. But what we are seeing is what the Fed hopes to see. Their models would suggest this is what's going to happen, that we're getting a slightly slower pace of job growth as the economy slows down. 390,000 jobs is a drop down from the 435,000 the prior month. And yet unemployment, which is supposed to jump because the Fed is going to send us into recession, doesn't move. So for Jay Powell, this is all kind of good news. And you throw in the fact that we didn't see a big rise in average hourly earnings, so it doesn't look like there's a wage price spiral.
Right.
And it's a step in the right direction. It doesn't mean that the Fed's going to have to do more or less, but it's going in the right direction.
What about the labor force participation rate? It ticked up to 62.3%. That's a good sign, too.
That's a good sign, too. The more people come back into the labor force, the less pressure there will be on companies to pay more money to attract people into the labor force. So for the Fed, that's also exactly what they want to see. There's almost nothing in this report that I would think would make the Fed unhappy.
Can I just get real for a moment? Because I think about David Weston's interview with Larry Fink of BlackRock yesterday, and basically saying that there's really nothing, the problems that we have in terms of inflation, supply chains, COVID lockdowns, the Fed can't fix, Mike. So I do wonder, you know, let's get real, everybody. The Fed's not going to be able to maybe bring inflation down completely. Is that fair?
That's fair. And I think the Fed knows that. They are counting on the fact that some of this is going to be transitory. As the economy continues to open up, we will see some of the higher prices, airfares, hotel rooms, used cars. Those increases will start to level off. But they can't do anything about oil, and they can't do anything about food. And so we're probably not going to get down to 2% anytime soon. They may be living with a 3% or a little bit higher inflation rate for a while. But their bet is, as long as we're going in the right direction, the American people will be happier.
So it's the trend line we need to watch.
Abigail Doolittle,
Speaking of trend lines.
Yeah, we've got the jobs report. We were waiting for that data. As far as next week looks, in the next few weeks, what's the data to keep an eye on? What's going to move markets? What's going to spur the market to go one way or another?
Well, it's interesting. I'm going to be interviewing Brian Vedig, the president of MPJ Wealth Advisors, in an hour or two. And I was just looking at his notes. He's expecting us just to be stuck in a range. In other words, that we may not do all that much. And I'm just looking ahead, to the jobs data next week. And of course, right now with rates higher, mortgage applications are always going to be important. And then CPI on June 10th is going to be a big deal. What are we going to see? The estimate right now, year over year, 8.3%. I mean, talk about the Fed having its work cut out for itself.
Can I quick watch? Yeah. You told us, or I think, wasn't it earlier this week, that you were watching Apple as an indicator?
Apple is always a stock that I watch only because it's the main, first of all, most managers need to own it. So that's one thing. But also it's the main weight to all of the indexes. And it is in a quote-unquote death cross, which is when the 50-day moving average goes below the 200-day moving average.
So shorter below the longer-term trend.
Exactly. So the near-term investors out. That said, it's holding important support. So it's a tough, there's just so many mixed signals right now. It's the same as the debate about recession, no recession, what's going on. And that's showing in all these markets.
It's down 3% for the week, but we also know it's been a tricky week. Guys, thank you so much. Abigail Doolittle, markets reporter at Bloomberg News, here in our Interactive Broker Studio, and Michael McKee, international economics and policy correspondent, not in the UK, but get cozy in his home there. Of course, here at Bloomberg News, though.
Let's get a check of the latest world and national news. For that, we turn to Denise Pellegrini in the New York newsroom. Hey, Denise.
Hey, thank you so much. Well, former White House official Peter Navarro making a lot of headlines today. He has been indicted on charges of contempt of Congress, and CBS is reporting he's in custody. All this after he defied a subpoena from the House panel investigating the January 6 attack on the Capitol last year. He's the second former Trump official, of course, to be charged with contempt. Advisor Steve Bannon was the first. Slowdown in hiring, as we've been talking about, but still stronger than expected job creation. President Biden praising that report, but also acknowledging the problems with sky-high inflation rates and urging Congress to act.
I want to work with anyone, Democrat, Republican, Independent, to deliver real solutions and real savings for the American people, not take money out of their pockets.
And Biden commenting during a trip to Delaware. People at high risk of COVID-19 may be having trouble getting those antiviral pills, and you can blame this, as a matter of fact, on limited guidance on how to give them out. Bloomberg's Nathan Hager explains what's happening.
More than 2,500 test-to-treat sites have been set up across the country for patients to be tested and prescribed Pfizer's Paxlovid pill or the rival from Merck. But some providers say it's unclear how those treatments will react to other drugs, how to apply the risk factors that qualify people for them, and how much supply is even available. Federal agencies have put out guidelines on all those concerns, but a leading medical trade group says the guidance doesn't account for nuances in an individual patient's medical profile. In Washington, I'm Nathan Hager, Bloomberg Radio.
All right, thank you, Nathan. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Denise Pellegrini, and this is Bloomberg.
Thank you so much, Denise Pellegrini there with World and National News. So it's been a big week. We've been hearing from the big bank CEOs. There's been an event and conferences going on, or a conference in particular. And weighing in today is the Citigroup CEO, Jane Fraser, at an investor conference today. And she, too, was asked about where's the U.S. economy headed.
Yeah, she said the U.S. will find it difficult to avoid a recession, though a severe downturn is not the bank's base case scenario. Here's what she said, quote, Europe definitely felt more likely to be heading into a recession than you see in the U.S., Fraser said. She just returned from a trip to Europe and Asia. She said that at an investor conference earlier today. Still, even in the U.S., a recession is not easy to avoid. This is what we heard at Milken, by the way, over and over again. Europe is the concern.
Right, exactly. It's trickier because certainly when it comes to the energy costs, right, they are feeling the direct pain when it comes to the war in Ukraine on multiple levels. And so it's been very, very tricky for them. What's interesting, too, though, let's not forget, right, how many times have we had a conversation around this table with our guests that when a Fed is coming out of an easy money environment or easy policy environment, it's hard to get it right. And this one's going to be even trickier because you are talking about a million spigots that were thrown in terms of creating liquidity during the pandemic, and now you're turning them all off.
You are, but I got to go to what Mike McKee just told us.
About what?
About the latest jobs report. He said that, there's nothing in here that the Fed doesn't love. There's no big rise in hourly earnings, so no wage price spiral.
Right.
This slightly slower pace of job growth means the economy is slowing down, but this is all good news. And it kind of increases the chances that there could be a soft landing.
Okay. Come on.
Did I interpret that incorrectly?
We just got back from Vegas. Step up to the
Did I interpret that incorrectly?
Step up
Mike had all good things to say.
Well, it's a strong jobs, which is a good thing. You want Americans working.
You do, but if you're the Fed, you also want to see a slowdown because, like Fed Chair Jay Powell has said recently, the job market is too hot. It's unsustainably hot.
And you don't want the wage pressures either.
Exactly.
1 month does not make a trend.
All right. There you go.
I'm not usually such a bummer. I should have had the ice cream today. That's all I'm going to say.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The focal point is the May employment report. The numbers were stronger than forecast, and they really suggest that the Fed is going to have to remain aggressive to fight inflation. Non-farm payrolls up by 390,000 last month. The unemployment rate remains unchanged. We have yields across the U.S. yield curve moving up. 10-year Treasury now at 295 with a gain of about 5 basis points. On the shorter end, a 2-year at 2.66% with a gain of about 3 basis points. Dow Industrial Average down 0.9%. We've got the S&P weaker by 1.5%. NASDAQ comp trading in by about 2.4%. Shares in Novavax tumbling by more than 22%. This is after U.S. regulators raised concern over the company's much-anticipated COVID-19 vaccine. Briefing documents released today by the FDA noted some heart risk with this shot. And we have shares in Tesla trading lower by just about 9% right now. Reuters reporting earlier that CEO Elon Musk said Tesla may need to cut 10% of its staff. Tesla shares off 9%. In the bond market, I mentioned the move up in rates, and one of the things that has done is strengthen the dollar. The Bloomberg Dollar Spot Index is now rising by 0.4%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Muni bonds. Hey, hi. Sorry, everybody. Tim and I were doing...
Full disclosure.
Yeah, we were doing the Bloomberg News quiz. We both got one wrong. But
we were also listening to Doug Krisner.
Yeah, we were.
Of course.
I got the muni bond question wrong. What did you get
wrong?
If
you are a Bloomberg Terminal customer, you can go to QuizGo. You can take the Bloomberg News quiz every week.
What did you get wrong?
I got the one about how much OPEC Plus agreed to increase output.
50%.
50%. But that was still did well enough to beat 98% of other people who've taken the quiz. Carol, I'm tied for 4th place, and that does put me ahead of your 9th place.
I'm moving on. Let's talk about the monthly jobs report.
Oh, that's what we're talking about.
Yes, exactly. U.S. employers hiring at a robust clip in the month of May. Wage gains holding firm, suggesting the economy continues to power forward as the Fed raises interest rates at a steep pace to tame red-hot inflation. As Mike McKee said, good report, Fed should be happy.
Susan Arthur is the Chief Executive Officer of Career Builder. Susan joins us on the phone from Philadelphia. Good to have you with us, Susan. Do you agree with our own international economics and policy correspondent that there's almost nothing in this report that would make the Fed unhappy?
Hey, thanks for having me on, gang. Yes, I would agree. There's not too much to be unhappy about. We are pacing about 800,000 jobs under pre-pandemic. So obviously the continued growth here is restoring us to almost to pre-pandemic levels.
All right, you sound kind of worn out. Is it just the flow of news? Is it that things are rough out there? Like how would you assess the job market kind of compared to pre-pandemic, compared to the, I mean, listen, to be fair, I'm exhausted, and we've got an alcohol guest at the end of the show, and they're not sharing any alcohol with us, so I'm pretty ticked off right now.
It's almost like this is like actually true, Carol. I mean, she's showing all her cards.
I'm being very real, Susan. I really am. No, but to be fair, give us an assessment, because the job market is so important to what happens, especially when we have so many big banks, CEOs talking about recession, not recession. How do you see it?
Yeah, I would say so under the numbers, the big movers are what we've been hearing, right? We're moving from consumer goods to services, with the biggest gainers being leisure, hospitality, professional and business services. What we see in our data and the polling we do with job seekers is there's still an incredible number of employed people in an active search process. So while, lots of people are employed and we like the unemployment rate level and the progress with participation rate, more 55-year-olds came back to work this month, there are still a lot of people looking to make a change. So
that's a good thing, right? That's a good thing.
And I mean, it's interesting, Charles, because your point about being exhausted. The other thing we got in our most recent polling data is 2/3 of people would choose money versus an additional week off. That did surprise me, considering sort of some of the burnout going on, right? But of the people looking for work, the younger generations or to make moves, the younger generations are looking at twice the rate of the older generations, literally twice the rate. Lots of people prioritizing money first, followed by a flexible schedule and remote work. So those trends are holding and gaining. So when we think about what's going to change over this period, who's going to make moves, where are they going to go, associated with growth in sectors, I would expect a lot more movement of the younger generations, and that it isn't about culture or purpose. It is money and flexibility.
Well, help us connect to this to what it says about the economy and what happens in an economy where workers feel like they have that choice. They have that ability to move. Doesn't that manifest itself in higher wages and a higher quit rate?
I would expect the higher quit rate to hold whether or not the wage growth. I mean, I think that 5.2% this month is, obviously ticked down a little bit from last year, but from last month. But obviously, there are outliers in that. If you look at leisure and hospitality, significantly above pre-pandemic levels. So I think, people are still going to jump. It isn't always going to be for money, but there's going to be competitive pressure on the employers for sure.
Susan, I think what you were saying is so fascinating about this whole idea of people prioritizing money first. I had a fascinating conversation with an Uber driver yesterday and trying to buy a home, talking about mortgage rates, talking about costs, talking about what it costs to fill up his tank, over $100, and just being like, this is really rough. Searching for baby formula. Like, this is real. This is America talking and saying how difficult it is. And when it comes down to it, you want to make sure you have enough money to put a home, a roof over your family and feed them.
Agreed. And if we went back pre-pandemic, I would expect our trending in the younger generation job seeker to lead with purpose, to lead with advancement, to lead with alignment to company culture. Those things are moving further down, and folks are focused on, food and water here. Followed by flexibility, because there's a lot of people doing gig work. There's a lot of people that side hustle. So flexibility thing isn't just that people like remote work. It's that they're needing to optimize their time and the economics of their time.
If you had to assess the outlook for the rest of the year, recession, no recession?
I hope we have solid indicators here that mean we're going to land okay. But to be determined.
Is that just in 10 seconds, a cynical to be determined, pessimistic, or optimistic?
No, not pessimistic. I mean, I just think there is incredible growth out here and a lot of good work and innovation going on. So, not pessimistic or cynical at all. Okay. I'm hopeful.
I gotta say, I love it. You were real. I'm in a real mega get real mood and mode today. So, Susan, thank you so much. Have a good and safe weekend. Be well. Susan Arthur, she's Chief Executive Officer at Career Builder, understands, sees what's going on in the job market firsthand, joining us on the phone from Philadelphia. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I still can't believe you beat me on this quiz.
You got to get over it, Carol.
I don't think I've ever broken the top 10.
Well, I broke the top 5 today, and that's just going to hurt you. I'm sorry.
You're such a nice guy.
I am, but you know,
this happens.
we're both competitive.
You know who's always nice?
Who?
Ed Ludlow.
I know, he is. He's been up since the early morning talking about Tesla and Twitter. And, of course, the glue that binds them together, Elon Musk.
Elon Musk, right? He had people sleeping in his Shanghai factories, and now
He was sleeping in his factory in Nevada 2 years ago.
And now there's going to be less people at the company. All right, we're going to get into it with Ed Ludlow in just a moment. Tesla shares, by the way, they're tanking today. Let's get a check once again on the trading day. Those top business stories. Here is Doug Krisner.
Hey, Carol. Yeah, the Tesla story is tied to a report from Reuters on Musk saying that Tesla needs to cut 10% of its staff. The stock right now is weaker by about 8.5% off the session lows, if you can believe that. A lot of the focus for the market today is on this employment report for May, the numbers above forecast, and it really points to the idea that the Fed is going to have to remain aggressive in fighting inflation through higher interest rates. In the bond market right now, a 10-year Treasury is up by 5 basis points in yield. We're at 295. The Dow, meantime, weaker by about 0.8%. The S&P down about 1.4%. Of the 11 industry groups within the S&P, energy is the only positive. Mentioned the weakness in Tesla. That's leading the consumer discretionary group lower. We also have a slump in information tech and communication services stocks. Shares in Novavax being very hard hit today, right now off by more than 21%. U.S. regulators have raised concern over the company's much-anticipated COVID-19 vaccine. Briefing documents were released today by the FDA. They noted some heart risk with this shot. Now, next Tuesday, the FDA is going to meet with its advisory committee as it considers an emergency use authorization for the Novavax vaccine. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Doug Krisner there. Well, shares of Tesla, they are definitely under pressure today. I was just going to bring them up. I know they were down about 8 or 9%. Forgive me. Just let me pull it up on the Bloomberg. Yeah, they're just off their lows. They're down about 8.7%, tanking, down more than 30% year to date. Tesla CEO Elon Musk saying the car maker needs to cut staff by around 10%, noting he had a super bad feeling about the economy. This was an internal email seen initially by Reuters.
Well, joining us now is Ed Ludlow, West Coast correspondent for Bloomberg News. He's with us from the Bloomberg 960 studio in San Francisco. Ed, I was really surprised to wake up early this morning and see this report, given what we heard from Elon Musk just a week ago. Contrast what we heard from him in this Reuters report to what we've been hearing from him via Twitter and more.
Yeah, you were surprised because you woke up early, or you were surprised by the news?
Nice.
What?
I did sleep in a little bit.
Yeah, so Elon Musk sent out 2 memos, and there are 2 memos circulating on Twitter, different media outlets reporting, but the first said that they would need to cut 10% of Tesla's global workforce, and Elon Musk saying that he was seriously concerned about the state of the global economy. The follow-up email clarified that he was talking about 10% of salaried employees. And that's really important because where I am here in the Bay Area, guys, and near you in New York State, right, at the battery facility that they have in New York State, a lot of those workers are contractors. They're hourlies. They're not salaried employees. And Elon Musk clarified that some of the cuts he's talking about, those protected from them are the people that are actually building stuff, cars, batteries, etc.
So in other words, those who are building stuff are needed to meet demand, right? Because the demand is there. Is that fair enough?
Smart. That you're exactly right. And it's interesting because I've been talking about demand a lot on TV and radio all day long. Like, what do we know about Tesla in this environment? Tesla has been more nimble than other manufacturers with its supply base. It's circumvented the supply chain crunch to a large extent that we've seen around the world, and it's raised prices multiple times. The narrative has been the demand is there and they need to get all hands on deck to get these cars out there. I guess the interesting part is like what's changed with this memo and the news. It was just a week ago that Elon Musk tweeted he foresaw a recession of 12 to 18 months. And Tim, I think that's what you were alluding
exactly.
to, right? That his views kind of changed. And maybe it is that demand side of the equation. But the other thing is that Tesla ballooned during the pandemic era, right, to more than 100,000 employees globally. It grew really fast. And maybe this is just them pumping the brakes a little.
Yeah, I mean, look, we've heard similar things from smaller companies, including PayPal and others that did balloon during the pandemic,
but
too.
Is Tesla a pandemic play?
No, it's not, but the stock price increased drastically during the pandemic. So in that sense, it was a pandemic play for a lot of retail investors.
Okay.
Ed, I'm wondering, though, what this means and why are we seeing the stock down today, as Carol mentioned, because of concerns about a slowdown? Because if the company is indeed going to reduce headcount, not contractors, but full-time salaried workers, then that could be a good thing for margins.
Yeah, I just want to be honest with the global radio audience and those watching on YouTube. Like, we really don't know what's going on in Elon Musk's head and the rationale behind this. And I think, you know, based on the conversations I've had, the market feels the same. There's a bit of confusion here because when Elon Musk did send that tweet a week ago about foreseeing a recession of 12 to 18 months, he also said that he wasn't worried about it because he felt it would only impact those companies that had weak cash flow or weak cash on the balance sheet. You know, and the inference was that at that point that he felt Tesla wasn't in that category. So there is confusion. The other thing as well is like, where they're cutting back. Tesla has been pushing super hard, and Elon Musk tweets about this a lot, about hiring artificial intelligence talent and hiring insurance talent. But those are business areas where they're not making a physical product. They're trying to develop new areas of the business. And so I think maybe the market's saying, well, hold on, I thought you guys were talking about growing in those areas. Are you now scaling that back?
So how do you net this in terms of what it means? It's Elon Musk, who can often change, you know, what he says. You know, we see that often.
Yeah.
But how do we, as investors, there are a lot of them in this company, it's a massive company, significant to the markets. How do we kind of net this?
Yeah, I mean, I'm not an investor, right? I'm a financial journalist, and the one person that we never really talk about is Zachary Kirkhorn, the CFO. We talk a lot about Elon Musk, but on the Bloomberg terminal, go onto EVT Go and pull up the transcript from the last earnings call and read Zachary Kirkhorn's comments on the headwinds the company was facing at that time and the expectation of how those headwinds would change as the rest of the year developed. He talks about margin pressure from inflation, from rising commodities costs, from the extra cost of moving things around from a logistics supply of the supply chain, logistics side supply chain. So this isn't like that new an idea. Zachary Kirkhorn was transparent about the challenges that Tesla was facing. It's just that he doesn't cause the same noise that Elon Musk does, and he doesn't communicate in the same way that Elon Musk does on Twitter or through mass emails to staff.
All right, we're going to leave it on that note. Great analysis and something to really think about as we head into the weekend. Ed Ludlow, he's had another busy week here. Certainly a lot going on in terms of his coverage universe. He is our West Coast correspondent at Bloomberg News in our 960 studio in San Francisco, though. Tesla, one of the bummers, certainly a laggard. Unless you're shorting it, then you're benefiting. This is Bloomberg.
Let's get checking the latest world in national news with Denise Pellegrini in the New York newsroom. Hey, Denise.
Thank you, Tim. Well, former White House official Peter Navarro has been indicted on charges of contempt of Congress. CBS reporting Navarro's in custody. That's after he defied a subpoena from the House panel investigating the January 6 attack on the Capitol last year. Mick Mulvaney is former acting White House chief of staff for former President Trump, currently founder of Exodus Capital, and he tells us today the hearings coming up next week on the January 6 riot. And the whole investigation, as a matter of fact, he says, is purely political.
Tell me how you voted, and I know how you're going to feel about this commission. I continue to think that January 6th was a travesty, but going about it in a heavy-handed political manner is not the way to solve any war.
And Mulvaney with us there with David Weston on Balanced Power, heard here on Bloomberg Radio. Slowdown in hiring, but still stronger than expected job creation in May, as we've been reporting, and President Biden praising the jobs report out today, but also acknowledging the problem of high prices, sky-high inflation rate as well.
I know that even with today's good news, a lot of Americans remain anxious, and I understand the feeling.
And Biden commenting during a trip to Delaware. Canada's prime minister is accusing China of harassing Canadian military jets. Justin Trudeau calling the situation, quote, extremely troubling, according to the Washington Post. And the number of U.S. monkeypox cases is up to 20. And the government has begun shipping drugs and vaccines now to 8 states that requested them. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini, and this is Bloomberg.
Thank you so much, Denise Pellegrini with World and National News. So you are listening to Bloomberg Business Week. Carol Massar, Tim Stanovic, live in our Interactive Brokers studio here at Bloomberg headquarters in New York City. We are also streaming on YouTube on this Friday. Big story, big corporate story. You can hear about it in our weekend show on Bloomberg Radio, which hits Bloomberg Radio at 8 a.m. Wall Street time, also on our podcast feed. Big corporate story about Sheryl Sandberg. She's leaving after 14 years, was it?
Yeah, she's been there since 2008.
Facebook, now Meta Platforms, leaving as the company's chief operating officer, but really a chief architect of so much that happens in terms of Facebook and their top and bottom line.
Yeah, we've been reading a lot of stories. It's now day 3 of coverage of this. So beyond the news, there's a lot of analysis happening. And one of the pieces that got our attention was one in the Wall Street Journal, available at thewallstreetjournal.com and, of course, on the Bloomberg terminal as well. It's about burnout driving Sheryl Sandberg's exit from Meta. And I'm going to read right from it because you got to do it in their words.
Very specific.
Yeah, Sheryl Sandberg's departure from Facebook parent Meta Platforms came as a surprise even to many people close to the tech giant. In reality, it was the culmination of a years-long process in which one of the world's most powerful executives became increasingly burned out and disconnected from the mega business that she was instrumental in building.
I'll continue reading. More recently, there was a fresh irritation. Earlier this year, the Wall Street Journal contacted Meta about 2 incidents from several years ago in which Ms. Sandberg, the chief operating officer, pressed a UK tabloid to shelve an article about her former boyfriend, Activision Blizzard's CEO Bobby Kotick, and a 2014 temporary restraining order against him. And the episode apparently dovetailing with a company investigation into her activities, which has not been previously reported.
You know, Carol, I don't think, and this is a point that Katie Greifeld made yesterday on our Quick Take show, Quick Take Stock, that airs at noon each day, that you'd be hard-pressed to find the exit of a COO garnering this attention anywhere at a company anywhere in the world, more so than this one.
But she was,
she was the adult in the room.
She was the adult in the room, hand in hand, working with Mark Zuckerberg. And so, we all, I think there may be more to come. But anyway, this is one report by the Wall Street Journal. This is...
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Weak session for the equity market today after the May employment report came in above forecast. It really implies that the Fed is going to have no choice but to be much more aggressive in battling inflation. Non-farm payroll growth, 390,000. The unemployment rate unchanged at 3.6%. Even before this report, the Fed was seen raising rates by 50 basis points at the next two meetings, and now market-derived odds suggest an 85% probability for a third rate hike of a 50 basis point magnitude at the September meeting. You know, this move to tighten financial conditions really is aimed at reducing demand, right? And thereby relieving price pressures. Now, remember, the Fed has only raised rates 75 basis points as a part of the current tightening cycle. So you ask, well, is recession the logical outcome? Citigroup CEO Jane Fraser said today it's difficult to avoid a recession here in the U.S., although that is not Citi's base case scenario, at least at this point. Dow Industrial Average weaker by 0.9%. We've got the S&P down about 1.5%. Consumer discretionary being very hard hit today. Tesla shares being clobbered. Stock is off about 9% right now after Reuters reported Elon Musk saying Tesla needs to cut 10% of its staff. And shares in Amazon, curiously, trading off about 2.2% right now. The company's 20-for-1 stock split will take place after the closing bell today. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much, Doug Krisner. Well, out today at businessweek.com, also on the Bloomberg terminal, how NRA lobbying is curbing research that can prevent gun violence deaths. This story so relevant, obviously, to what's going on today.
Yeah, really important one, written by Madison Muller, health reporter for Bloomberg News. She joins us in New York. Joel Weber is the editor of Bloomberg Business Week. He joins us really far away today. I think he's on vacation, but he's taken some time to join us from Oregon this afternoon. So really appreciate that, Joel. Joel, when we think about the conversation around gun control and specifically around federal funding into research about how to prevent gun deaths, where do we need to start?
Well, that's really what Madison did a great job kind of just genuinely surprising us with this story that ran as a remarks today from the magazine. The thing that just really surprised me was that there's actually a different way to look at gun violence, she writes, which is to think about it as basically a health epidemic. And yet that conversation has largely been muted because of NRA's lobbying ability. So Madison, bring us up to speed on what you found as you reported this story.
Yeah, definitely. I, as a health reporter, am sort of always thinking about the public health impact or the health story behind things. And I had seen some data after the most recent shootings that gun violence had become the leading cause of death in kids and teens under the age of 19. And I was like, okay, well, obviously that's a health issue. And so started talking to some experts in this field, people who have been studying it, about why the U.S. doesn't really treat gun violence as a health issue, despite the huge mortality impact that it has on especially kids and teens. And sort of led me down this path of learning about how, back in the 1980s and 1990s, the NRA started lobbying against research and funding from the U.S. government to study gun violence. This is something that it's really bipartisan. It's evidence-based. It's based on science. It really looks into the root causes and why gun violence is happening versus going immediately to policies based on, more political elements.
Well, Madison, this is the part of the conversation, I think, where we have to talk about Jay Dickey, the Republican representative from Arkansas, and the so-called Dickey Amendment, because that name just keeps coming up over and over again when we talk about funding this type of research.
Yeah, so that was really interesting and sort of surprising kind of in retrospect, because in 1996, Jay Dickey was a member of Congress, and he, at the time, described himself as the NRA point person for Congress, and he really was the one that pushed for funding cuts for this research, and also for language to be added to the appropriations bill to sort of make sure that the CDC couldn't continue doing this type of research. And it was unclear at the time whether they were completely barred from doing research or whether it was just research that appeared to advocate for gun control. And so there was confusion, and a lot of CDC scientists were sort of scared. This is what, experts have told me. They were scared to talk about gun violence after this. They thought funding was going to get cut to some other studies. And so it really, then that's when research was heavily restricted. And years later in 2012, Jay Dickey actually came out with, former member of the CDC, and said he acknowledged the impact that these funding cuts have had on research and on the situation, and said that this is really the only bipartisan approach to this problem, and the the scientific approach to it is what we need to do going forward.
I do feel like, to some, I don't know, not apples to apples, Madison, but it does feel like, we've been here before smoking, right? What companies knew and what the impact it had on people's health. I feel like the fossil fuel industry, like there are things we know, the impact on climate change, and here we are again. I mean, I got to tell you, I'm no rocket scientist, but I don't need a lot of research to tell me that you put, automatic weapons out there, and kids and people who shouldn't be, nobody should be impacted by them. And so I just do wonder why this hasn't had a bigger impact, even some of the early research that's been out there. Is it just nobody wants to touch it politically? Is the NRA that powerful?
That's a good question. And I mean, I think that's especially, the point you bring up about us knowing and having a lot of information about various things that impact our health and are huge issues, but maybe not taking the action that we need to combat them. And, I think people really don't know. I think what experts were telling me is that they have missed out on 20 years of knowing how to effectively combat gun violence. So because of these, research and funding cuts back in the late 90s, we really don't have the information that we should about this as a health problem. And so it's been difficult to craft effective policies around that and to discuss it as a health problem, because it just hasn't even really been considered one, because it hasn't been being studied as one. And, in recent years, the funding has picked back up. There's, a little bit of funding still, significantly less than other public health issues. But researchers are really starting to look at this as a health issue again, and the CDC has said that it needs a public health approach. So, hopefully that will lead to some more effective change.
Just on that note, Madison, I'm really curious because there's some agencies that you mentioned in the story, and it was surprising to me because they're all very squarely in your lane as a health reporter, and those are Health and Human Services Department, CDC. What's the perspective, NIH, another one? What's the perspective that you heard when you reached out to those organizations, which is not something that we usually hear from around anything relating to this topic?
Right. Yeah, and that was super interesting to me. I know that the CDC now is funding over 16 different projects, related to gun violence, and are really investing in expanding their data surveillance and expanding studies that look into, one, what's causing gun violence, and also preventative solutions for it. So they're, in Chicago, got Northwestern University and University of Chicago got $2 million in funding from the NIH to study community level gun violence programs and evidence-based programs to see if this violence prevention intervention could work.
Wow, it's a really important story, and I'm really glad we were able to get to it. I also think it is significant to have the health reporter do this because it does impact everyone's health potentially. Madison Moeller, health reporter at Bloomberg News. Joel Weber, editor of Bloomberg Business Week. Check out this story at Bloomberg.com, businessweek.com.
down to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session, in your trading week. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic, as we together once again embrace our TV, radio, and YouTube audiences with the news that volumes are low and the stock market is falling.
I feel embraced. Thank you very much, Caroline, for that.
Friday warm embrace.
Feeling the love, feeling the love. Not so much love, though, in the equity markets, unless, of course, you're shorting this trade. Bouncing around, but we're off our lows and highs, but definitely down across the board, as Caroline just mentioned, except if you happen to be a biotech stock, because that is certainly some outperformance today. The group overall, if you look at the Spider Biotech ETF, it's up about 3.2%. Thank you, Bristol Myers, for making a bid and paying more than double per share, if you will, for Turning Point Therapeutics. That's a $4.1 billion bid, $76 a share, so that's double the closing price of what we saw for Turning Point as of the close yesterday. So investors moving into biotechs today.
Well, we're also seeing chip stocks under pressure. This after Piper Sandler downgraded Micron Technology. All 30 members of the Philadelphia Semiconductor Index are lower today. Overall, it's down 2.6%. The stock's underperforming the NASDAQ, being led lower by Micron, which is down more than 7%.
Let's have a little look at how that winds up being the NASDAQ that underperforms. We're off by 2.3% on the day for the NASDAQ. That's 283 points lower. We're also seeing, though, the S&P 500 off by 1.4%, both seeing volumes really muted by about a quarter overall. In fact, they're down by about a third for the Dow Jones Industrial Average. We're off by 0.8%, and the volumes have compared to usual 20-day average. Russell 2000 off by 0.8%, and that means on the shortened week, we are to the downside across the board.
Indeed, we were looking at some back-to-back gains at one point, Caroline, and unfortunately sort of unable to get there. Unfortunately, I'm a broken record. The theme of the day is the theme of the year. I just continue to repeat myself here. Energy, the best performer of the day, best performer of the year. You're still up about 1.6% or so on the energy sector. Everything else, though, all the way down in the red. And Romain, technology is one of the worst performers. You're off about 2.2%. B of A coming out and saying that this growth outperformance that we saw lately was just a phenomenon, that value typically has been the big outperformer. Tech is a huge laggard in some of these stagflationary environments. So again, sort of the negative sentiment around technology continues today.
Yeah, and we talk about some of the movers. I mean, we were talking a lot earlier today, of course, about the commentary out of Elon Musk here, and the idea here that, he sees, in his words, of course, some super bad issues going on out there, and could potentially cut staff, at least salaried staff, by about 10%. But we've been hearing similar commentary on a lot of other companies. We heard from Coinbase last night that the hiring freeze that they had put in place being expanded just a little bit to now actually include rescinding job offers already made. We heard some interesting commentary out of the CEO of RH, Gary Friedman, last night, who talked a lot about macroeconomic conditions. In fact, I was going through the conference call transcript, and you would have thought you were in on a Fed call or something. He spent more time talking about interest rates and the Fed than he did about furniture and wealthy people. But it gets to the idea, I think, of what is on the minds of a lot of these CEOs and CFOs, for that matter, right now. And then at the bottom of your screen, you take a look at Amazon here, $2,454 a share. Starting Monday, that share price is going to be down around $115 or so after they do a 20-for-1 split that takes effect after the close today.
So much more affordable, right?
Yeah, absolutely.
Meanwhile, let's have a look at the S&P 500 because, well, we were thinking we could have got another weekly gain out of this, but no, today put paid to that. The sentiment, as you say, coming out of Elon Musk and some of the corporate leaders really turning to the downside, and we decide on low volumes to tick lower, and we've got a red week, having after 7 straight weeks of declines in the S&P 500, last week some reprieve, and well, already heard the likes of Mike Wilson over at Morgan Stanley and many saying, well, that was a bear market rally, watch out.
Well, and that kind of mirrors, if I look at the trade here, the concern among equity investors kind of mirrors some of the negative commentary we got from a lot of big folks and big names in the financial sector, right? We had Larry Fink of BlackRock telling David Weston that we could get a recession if the Fed overshoots. We had Jamie Dimon of JP Morgan talking about now going from storm clouds to a possible hurricane in terms of the U.S. economy. And Jane Fraser of Citibank, the CEO of Citibank, also talking about a recession and saying basically it's going to be hard for the U.S. to skip out on that. Here's what she had to say.
Europe definitely felt more likely to be heading into a recession than you see in the US. The US story is, as we all know, is much more about rates. With this, is a recession? It's certainly not our base case that there will be, but it's not easy to avoid either.
And that's the Strategic Decisions Conference. And of course, that's Jane Fraser, CEO, Citibank. Romaine, though, I do wonder, we were talking with Mike McKee, Tim and I earlier, in terms of the jobs report, it is going to be hard for the Fed to get this one right, although we did see some slight easing of wage pressures in this monthly jobs report.
Okay, well, then a week from today, we get the next CPI report, which at least is expected to ease a little bit, but it's going to ease from, 8.5% or 8.3% to 8.1% based on
But it's the trend line,
estimate.
right? If we start to continue to see these easing, hopefully it will start to build up and show much better numbers, no?
No, not at 8%. I mean, you're right. I mean, you're right longer term, but I think in the short term, when you talk about the idea, if we're going from 8.1 down to 7 or even 6 here, we're still in a mess here, and the Fed has to do something. 50 basis points at that June 14-15 meeting. Does that get us there? Another 50? Does that get us there? That's the question.
And not just the Fed.
Yeah.
Look, this is a global inflationary problem, and next week we look to what the ECB might do. Already the market before had never anticipated, we just started to bake in some rate hikes. December, they thought. Now, October, they're anticipating a 50 basis point rate hike from the ECB. So this is your European focus coming into play as well this week to look out for.
And still not sort of helping the supply chain issues, though I thought it was notable. We were speaking with Duckhorn, and we made a joke. We sounded like radio. We were like on TV talking about wine, which is typically...
We only do that
the
after
only
4
thing
o'clock,
radio
Taylor, on Fridays.
But they said, thankfully they weren't having a huge supply chain issue, but then you got comments from Walmart saying that they're starting to see some signs of easing up. But I have to say, I feel like we've heard this before, and every time we think that there's a little bit of an easing up, we don't yet quite see that in some of the data or the pricing.
I got to tell you, we had a really interesting conversation with the CEO of Johnson Controls yesterday, who did say that he was starting to see some easing when it came to commodity prices around the world. And he was pretty optimistic with his view.
Well, and just real quickly, there was some commentary just within the last hour or so out of the Walmart CEO, kind of saying similar things. That they're seeing similar things. I don't know who you're talking to, Taylor, if you're just hearing voices in your head. She's had like 4 Negronis already.
Taylor, we heard you.
I'm going over to radio.
We heard you.
Thank you.
You are always welcome here. We got an extra mic for you.
All right, we're going to run. We're going to be back.
Listen sometimes.
Really? Yeah, exactly. All right, we're going to be back in less than an hour's time. We're going to wrap up this trading day. We're going to wrap up this trading week on radio, on TV, on YouTube. Beyond the Bell, it's coming your way on this Friday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. The other thing I was going to say, and I wanted to add to that conversation, I hear what Romaine is saying. It's going to take a while for this to come down, but, it's not just about the Fed fixing this. Larry, think of BlackRock, kind of getting to this, that the Fed cannot fix COVID shutdowns, cannot fix the supply chain problems. And so it's going to be difficult. And then I think about Alex Steele, killer interview with Mike Wirth, the CEO of Chevron, saying there may never be a new refinery built in the United States despite surging gasoline prices as policymakers move away from fossil fuels. Folks, wake up. If we want to save Earth, if we want to save the environment, we can't keep doing fossil fuels. We're going to have to move towards alternative energy. It's going to be crappy and uncomfortable.
And it's going to take a long time, like we heard from the governor of New York earlier this week. 2040 is the time to get to net zero. By 2030, they want 70% of New York's grid to be net zero. Right. And they're building more than 20 solar plants around the state in order to do that. But this is not going to happen overnight.
Right. And if there are chips in everything, including those electric vehicles, you cannot just build a fabrication center overnight. It's a lot of money. It's a lot of time. Like, this stuff just takes a while. And this is where we need policymakers to kind of come in and figure out, how do we help their citizens, how do they help their domestic economies to get through what's going to be an uncomfortable time period?
Okay, speaking of uncomfortable, next week we're getting a lot of economic data.
Yeah.
CPI month over month, year over year, is expected to be 8.3%, which would match last month. It is an ugly number, but if you exclude energy and food, which you don't like to do, 5.9% down from 6.2%.
I don't know about you, but I do have to eat. Thank God I have a company that feeds me, but when I go home, I have to feed my family.
Let's get a check of the latest world and national news. For that, we turn to Denise Pellegrini in the New York newsroom. Hey, Denise.
Hey there. Well, some political news to tell you about. Former White House official Peter Navarro has been indicted, and this is on charges of contempt of Congress. CBS reporting he's in custody. That's after he defied a subpoena from the House panel investigating the January 6 attack on the Capitol last year. And Mike Mulvaney, we spoke to him. He's former acting White House chief of staff for President Trump, and he was highly critical today with us of what Navarro is doing.
You don't get to sit on the outside and say, well, this is a political stunt. I don't have to go. That's for the politicians to make that argument. That's not for the private citizens. And Peter Navarro, I think, as he's finding out, Peter always thought he was smarter than everybody else. I think we're going to find out if it's right or not.
Well, Peter Navarro thought he was smarter than everybody else, according to Mulvaney, with David Weston there on Balance of Power, heard here on Bloomberg Radio just a couple hours ago. The number of U.S. monkeypox cases is up to 20 now, and Dr. Daniel Karitz of Brigham and Women's Hospital says it's important to remember we have a monkeypox vaccine and effective antiviral medications as well.
Unusual to have such an infection. The last outbreak in the United States was in 2003, where about 70 people contracted that.
And the government has begun shipping drugs and vaccines to 8 states that requested them to fight monkeypox. In Albany, lawmakers have passed a package of bills for New York State tightening gun control access in the wake of those devastating mass shootings in recent weeks. Among other things, these bills impose age restrictions on the sale of semi-automatic rifles and ban most civilians from buying bulletproof vests, and also close a high-capacity magazine loophole. Global News, 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. You are listening to Bloomberg Business Week home answer, along with Tim Stenevik. It's just nuts.
It is nuts. Shortened trading week. Shortened. You don't buy it. It doesn't feel like a shortened.
It was dense this week. There was a lot of big news and a lot of big moves in the markets.
Fed speakers too.
Yeah, well, they're cramming it in.
They got to get it in before the blackout starts. I believe that's tomorrow, Carol. You sent this article across earlier because we're talking crypto.
Yeah.
The Federal Reserve Governor Chris Waller said regulation of crypto trading might be desirable to keep taxpayers from being asked to compensate for losses in a new volatile market, as well as to prevent bigger market stresses.
I have no idea what that means. All right, so here's a quote, which doesn't mean anything. And you folks who are listening and watching are a lot smarter than me, so feel free to help me out here. But here's the quote.
You're not creating your own crypto? You're not doing this from the
How'd
metaverse?
How'd you find out on the weekend? That's what I'm doing.
Blockchain master?
Yeah, there you go. All right, so here's the quote. The main issue in crypto asset regulation isn't how to protect sophisticated crypto investors, it's how to protect the rest of us, Waller said in the text of remarks for a conference in Zurich, Switzerland. He goes on to say it's not to protect high net worth investors, but to protect society from the often irresistible pressure to socialize the losses of investors with limited resources and to limit the spread of financial stress. This is something we're going to get into with our next guest.
Yeah, Waller said that in a hot new market, investors face a, quote, meaningful chance of losing money. When individual investors face large losses, it's very possible that will become, quote, politically or morally intolerable and will lead to calls for the government to step in and cover those losses, he said. One thing that I find notable about the recent tumult in the crypto market is that despite the fact that we are seeing, hiring freezes and rescinded offers at companies like Coinbase and layoffs at companies like Robinhood and Gemini from the Winklevoss twins, that's
Winklevi.
That's Winklevi to me, is what happens to interest around crypto with these price declines, with this massive wealth being just evaporating in the last few months?
Well, and it feels like
does it scare people away?
I don't know, potentially, but it feels like what he's saying is we've got to make sure that maybe it's the sophisticated investor, I guess, who's playing in it. I don't know. We'll get into it more with our next guest, the founder of BitBoy Crypto.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
"17 minutes past the hour. The equity market is very near the worst levels of the day as we make our way to the closing bell on this, the final trading day of the week. Let's get you to the Bloomberg Macro Squawk Desk, get the very latest on the price action from Bill Maloney. Hi, Bill.
And good afternoon, Doug. U.S. stocks in the red from the start today, with the Dow currently down 384 points. S&P's dropped 74, while the NASDAQ is lower by 338. The U.S. 10-year yield at 2.95%. Gold is down 18. Oil is climbing, but Bitcoin is down by 2.2%. Among the main 11 S&P sectors, only energy was in the green. Consumer discretionary, telecom, and tech were under pressure. And leaders to the upside in the Dow, IBM, Caterpillar, and Chevron, while Apple fell 3.8% and led to the downside. In other news, Dow Jones said Boeing had a production pause in May, and the Amazon CEO of Worldwide Consumer resigned. Wrapping things up, Starbucks has reopened almost 600 of its 940 stores in Shanghai. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
Hey, Bill, thank you. To get live audio updates right on the Bloomberg terminal, the function is SQUA, then the green go key. 19 past the hour, that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Well, in our weekly crypto segment, an investor and content creator in the space, back with us is Ben Armstrong. He is founder of BitBoy Crypto and the YouTube channel that goes by the same name, a self-proclaimed crypto millionaire. I think that's how we described him last night. He joins us on the phone in Atlanta.
Ben, it's good to have you back with us. How are you?
I'm doing great today. How are you guys?
Doing well. Look, Bitcoin really seeming rage-bound right now. It's under $30,000, $29,500, according to the latest on the Bloomberg terminal. When do you think we'll see a bottom here?
That is a great question. I think we're looking at one of two scenarios. There is a scenario that exists to where, we call it the false top theory, that basically November, the top of 69,000 was actually a false top. It was really kind of an over-exaggerated dead cat bounce. We really look back at April as really actually being the true top. There's a lot of indicators to kind of point to that. Obviously, retail sentiment was the highest at that point. If that's the case, then we could expect to see a bottom for Bitcoin in the next month, maybe even over the next 10 days as things look very bad in the markets right now. But most likely what we've seen traditionally with Bitcoin is a bottom in November after the midterm elections. So we're really targeting, kind of the end of November, beginning of December. And I think that would kind of line up with a lot of the larger kind of macroeconomic problems that we're having right now that don't really seem to be slowing down.
Ben, here's my problem with the cryptocurrency world is I don't know what fundamentals to measure it against. Like if you give me a hard asset or if
Did you say fundamentals when it comes to crypto?
Oh, sorry.
We don't do fundamentals
I used the
in
wrong
crypto.
F word, perhaps?
Yeah, I don't know if you know this, Carol, but there's no earnings for Bitcoin. There are no cash flows.
Hence my confusion and problem with this.
Okay.
So how do I, like you say, okay, it could, midterms, we could bottom out. Like, how do you say that? Because what are you basing it on?
Well, when I say that, so we're looking at two separate kind of issues here. Number one, we do have fundamentals for Bitcoin. They're what we call on-chain metrics. So you can kind of look at the hash rate of Bitcoin. Traditionally, up until about the last year, generally when the hash rate has been at the highest, the Bitcoin price has been at the highest. We have seen that change a little bit recently. You can also look at, things we call the SOPR, which is like kind of how over the long term people are holding on to Bitcoin. We've got a lot of different measurements that have to do with addresses and wallets and whales and transactional activity that you can kind of measure and you can look and see connections between price and those generally. But also
are they reliable indicators? Are they going to create long-term cyclical historical cycles that I can kind of analyze in 10 years that are going to make sense? Or is it like so many people who come on air who say, listen, this is like the internet in the really early days, so get ready for some craziness?
Of course. And I mean, really, that's what we're seeing is that the hash rate has traditionally been an indicator, but it isn't working right now. So I think we've got to get a lot more time under our belt to be able to connect those on-chain metrics to the price. But what we do have is the history of the Bitcoin price and how it follows what we call the halving cycle. Every 4 years, we've seen Bitcoin do almost exactly the same thing. Hit all-time highs every 4 years, hit new bottoms of bear markets, every 4 years. And this is based off of the halving, which last one occurred in 2020, next one occurred in 2024.
Why is it
And
4
until
years?
that is-
Why is it 4 years?
Well, it's about 3 years, 11 months technically, because it's 210,000 blocks for Bitcoin is actually the distance between the halvings. So so far it's worked out to approximately every 4 years. So it's coded into Bitcoin to cut the production in half every 4 years or every 210,000 blocks. So, but of course, the average person, they can't conceptualize, 210,000 blocks for Bitcoin. So it's just easier to say every 4 years. It's kind of a layman's term that we use. So Bitcoin has pretty much always followed that same path. And if it follows that same path again throughout the rest of this bear market, like it has the previous two bear markets, then that would probably indicate a bottom sometime around November.
Okay, I want to move past this. Carol's still making sense of it, so am I. Are you satisfied, Carol?
No, but you go ahead.
Okay.
I consider you the expert in the room.
Well, let's not get ahead of ourselves here. Ben Armstrong's the expert, the founder of BitBoy Crypto.
he's
That's
just
why
not
we
in the
have
room.
him on the phone. Ben, I want to talk crypto winter here because we're just getting a host of bad news. We're hearing from the latest is among the latest, of course, is Coinbase pausing hiring and then also rescinding some offers coming after Robinhood layoffs and layoffs at Coinbase.
That's a fundamental I understand.
That
That's
is
usually not
there's
good.
a fundamental in the Gemini yesterday announcing layoffs. Are we in a crypto winter?
Oh, we are certainly in a crypto winter. I mean, I don't think there's any debate about that. And like I said before, it's predictable crypto winter. I mean, last year, even we were having high prices. We were predicting this year we were going to go through this. And every 4 years, you see the same thing where people say, it's going to be different this time. It's too much adoption. It's too mainstream. And yet we always continue to see the same bear winter play out. I think when you're looking at them cutting jobs, I'm not 100% sure this is as connected to crypto as it is just connected to the overall job market and the general economy. I mean, we look at Tesla. They said they were going to be laying off 10% of their employees as well.
Salaried.
And,
We should say salaried. We later learned.
Say that again?
Salaried employees, not contractors. So it changes the equation a little bit.
Just a little bit, but it's still 10% of those contracted workers. So they are showing a pullback. So I think connecting necessarily the layoffs at Gemini to in the hiring freeze at Coinbase to crypto, it isn't as relevant as it is to the larger market, I would say in general. We got the jobs report today. It looks very strong, and that's actually bad for the economy. That means inflation's still running rampant. It's not really pulling back yet. Don't expect any of the tightening to ease up anytime soon. I think it's only going to get worse, and I think this is having a big effect on all businesses.
We got to run. Hey, good to check in with you. Ben Armstrong, he's founder of BitBoy Crypto, on the phone from Atlanta. You're listening to Bloomberg Business Week. I still don't understand. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week on Bloomberg Radio, watching us on YouTube as we speak. Hey, one group Tim and I are keeping an eye on, the airlines. They're down another almost 3% in today's trade. American was out with some news.
Yeah, it's weird because the American news was good news, but the stock is getting crushed.
It's a good point. Frontier, Spirit, like there's some news
Lot
there
of
as well.
news.
So we're going to get into it with our go-to when it comes to all things in the airline industry, our own George Ferguson of Bloomberg Intelligence. We'll get to him in just a second.
First up, though, let's check in with Doug Krisner, who's got his eye on today's equity trade. Doug, what's the latest?
Well, the latest is we are very near the worst level of the day, Tim. We've got about 28 minutes to go until the closing bell. The S&P 500 is down about 1.6%. Energy is the only one of 11 industry groups right now that is positive within the broader market. Consumer discretionary, that's a Tesla story. The stock there is down nearly 9% after Reuters reported that Elon Musk said that the car maker needs to cut essentially 10% of its staff. And after the bell today, Amazon's 20-for-1 stock split will take effect. And shares right now in Amazon weaker by more than 2%. So as I mentioned, weakness in consumer discretionary broadly. Dow Industrial Average off about 1% right now, and the NASDAQ Composite is down about 2.6%. So with a stronger than expected jobs report for May, a lot of concern that the Fed has essentially got no choice but to lean in more aggressively to bring inflation under control. 10-year Treasury now up by more than 4 basis points to 2.94%. This Bloomberg Business Flash brought to you by Informatica. In the cloud, your data has the power to do the extraordinary. Manage data across any location in the cloud for accurate and actionable insights. More information at Informatica.com. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Gotcha, Doug. Thank you so much. Well, as we mentioned, we are keeping an eye on airline stocks. They're under pressure today. More than 4% at their lows as a group overall. They've come off a little bit off of that. American expecting revenue to balloon well above its original expectations this quarter as consumers swarm back to travel following the pandemic. And then we also heard from Frontier Group. They're sweetening the terms of its takeover offer for Spirit. So there's a lot going on in the space.
Fortunately, we have joining us somebody who knows a ton about this. George Ferguson is Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence. He joins us on the phone from New Jersey. George, I love talking planes. I love talking aerospace. And I love talking to you.
He really
does. We are happy to have you. I want to start with American Airlines. Why are shares getting crushed this afternoon after the company said that it would raise its sales guidance as demand rebounds?
Yeah, so thanks for having me on. The challenge here has been all the airlines have really come out and said revenue is going to be higher than they initially forecast for us. But what we're seeing them do as well is cut capacity, right? And so that capacity cut is an indicator to us that this higher fare level is actually leading to deteriorating demand. And so they're just not able to run the schedule they thought they could run earlier in the quarter. And then really challenging there is that we were looking for these higher capacity levels to help them drive stronger efficiency, right? And that better efficiency was going to help profitability a bunch. We've seen across the board, again, they're all sort of coming in with higher revenue numbers, but most of them are coming in with higher cost numbers as well. I think as we look at the industry, our concern is if we're shedding demand here, and this is peak summer travel season, what are we going to look like when we get into the fall and winter of this year if fuel prices are still at this level and they have to price fares where they are now? That's concerning to us. That's
a really good point. It's interesting because we were saying that it seemed like that the higher fare, I'm losing my brain here a little bit. What was interesting is Tim and I just flew. And we were on a flight where it seemed like they were canceling flights because they couldn't get workers. So It sounds like what you're saying is that the higher fares are actually leading to less demand. Is that am I getting it right, George?
You are, and they've been telling us that they're having challenges with labor, and we hear that too, right? And we know that it's harder and harder to schedule pilots because there's still COVID rolling around the system. Pilots get sick. You have to knock some of the schedule down for that too. But I don't think that's all of the schedule cuts, right? I think that that's a convenient excuse, but I think that's not the entire reason for the schedule cuts.
How much do daily airlines move in the opposite direction of oil prices?
It depends, right? Because even the other day, look, we saw OPEC come out with some comments the other day that I thought were maybe a little bit favorable. I realized the cuts were small. Actually, oil went up slightly on the day, and airlines were still, pretty down on the day. And so, usually you'll have the airlines move inversely to oil. And for sure, I think that's one of the things we should all think about here. If you're involved in airlines, if we do get something like OPEC were to come back with a really strong a really strong add of oil into the marketplace, and we saw a pretty good fall in oil prices, that would be a strong positive for the airline's profitability, right? They sold these tickets at higher fares.
Right.
But lately we're at levels that demand gets shed because of the fare level that they have to go out at these oil prices. And so some of that sort of relationship, I think, is broken down a little bit, but I don't have an exact number for you.
Well, and Tim, who were we talking to this week? Was it Ellen Wald or something that said that in terms of jet fuel prices, like we hadn't seen the demand necessarily come back pre-pandemic? Is that correct, George?
The demand for jet fuel itself?
Yeah.
Well, we're not yet at 2019 levels of capacity, for sure. Not in the domestic market in the U.S., definitely not international. Domestically, we're probably 5% or so below 2019 levels. Internationally, even more, 10 or 15 at least. And so, the demand isn't there. But we also have this problem with the Russians invading Ukraine. That's interrupted, some of the oil flows into European refineries that were feeding some of the U.S. Northeast. And so, if you look at jet fuel prices too, it isn't just oil. It's that crack spread. It's that, it's the price of the refined product compared to even the base oil product that's getting the airlines. They're kind of getting both those headwinds. And, I don't know how, that's another challenge. I don't know how we fix it. When I talk to my energy guys, they tell me there's a shortage of the ability to refine diesel, and that's also heating oil,
right,
and things like that. And so that's driven the crack spreads up, and that's another pain for the airlines.
George, 30 seconds. Business travel, is it recovered? Carol and I have been traveling a lot.
Yeah, more than
not fully. Not fully. I think we're 70+%, but not fully. Coming.
It's interesting, too, what you said about your energy guys, and I keep thinking of the interview that Alex Steele did today with the Chevron CEO saying there may never be a new refinery built in the United States. So
it's crazy.
Right? Yeah, huge. Thank you so much. We really wanted to cover this sector, and we did want to cover it only with you. So thank you so much. George Ferguson.
Appreciate it.
You bet.
Enjoy it.
Be well. Senior aerospace, defense, and airlines analyst at Bloomberg Intelligence on the phone from New Jersey. I thought that was really interesting because you and I have been talking about that it's a lack of employees to maybe fill and service the planes, and yet he's saying, no, there's also some weakness in demand.
Remember the plane before us that was canceled.
Yeah.
They couldn't find a co-pilot.
Exactly. All right, let's get back to world and national news. For that, we head over to Denise Pellegrini. She is on it. Hey, Denise.
All right, thank you. Well, former White House White House official, Peter Navarro, trade official, has been indicted on charges of contempt of Congress. That's after he defied a subpoena from the House panel investigating the January 6 attack on the Capitol last year. And we asked Mick Mulvaney, former acting White House chief of staff for then President Trump, if Navarro has something to hide.
Is it possible with Peter? Sure. Peter, I always thought Peter was a loose cannon and capable of saying and doing anything. In fact, I've been extraordinarily critical of the staff, including my successor, Mark Meadows, in what they must have been allowing the president to hear, what they must have been saying to the president in the weeks and the months after the election. People lose track, I think, David, of the fact that the president of the United States is one of the most isolated and insulated people in the whole world, and they rely very heavily on their advisors. Yes, at the end of the day, presidents are responsible for who they choose to advise them, but at the same time, it's incumbent on advisors to give presidents good information and good advice. And Peter Navarro was the kind of person who was capable of giving the president the craziest advice I've ever heard.
And Mulvaney there with David Weston on Bloomberg Balance Power. New York Times, meantime, reporting today that Mike Pence, chief of staff, sent out a warning on January 5th to Pence security detail, fearing for the vice president's safety because of tension with President Trump. Watch for a wave of COVID in southern states, according to Dr. Ashish Jha, the coordinator of the White House COVID-19 response.
Really worried about what we're going to see with elderly people in the South this summer. And so we've got to really push hard on boosters, first boosters really, for older Americans in the South.
And Dr. Ashish Jha there. Global News 24 hours a day, powered by more than 2,700 journalists. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. Carol Massar along with Tim Stenovic live in our Bloomberg Interactive Broker studio. We're streaming on YouTube. We have referenced this a lot, an exclusive interview that our Alex Steele did with the CEO of Chevron. And basically what he said is the green policy push means billion-dollar investments may be stranded in coming decades. Check it out.
Building a refinery is a multi-billion-dollar investment.
Process.
It may take a decade. We haven't had a refinery built in the United States since the 1970s. My personal view is there will never be another refinery built in the United States.
All right, again, that is the CEO of Chevron, Mike Wirth, talking exclusively to our Alex Steele, host of Bloomberg Markets on Bloomberg Television, and of course follows the commodity space so closely. Worth going on to say you're looking at committing capital 10 years out. That will need decades to offer return for shareholders in a policy environment where governments around the world are saying, we don't want these products. We're receiving mixed signals in these policy discussions.
Yeah, because the Biden administration has appealed to OPEC and the U.S. shale producers to pump more crude to help lower gasoline prices this year. But even if oil prices were to fall, the U.S. may not have enough refining capacity to meet petroleum product demand. Refining margins have exploded to historically high levels in recent weeks amid lower product supplies from Russia and China and surging demand for gasoline and diesel.
It's tricky. I almost feel like, is it, does the U.S. have to get through this crunch, like they helped out farmers, right? Kind of guarantee some markets to provide subsidies. So, God,
politically, how do you do that?
To a publicly held company, right? That's made a ton of money. Certainly in the last
couple of years.
In the last boom. That's to be fair. There's booms and busts.
Yeah, and it's a cyclical, like, your sources are telling you.
Right, exactly. So, how do you do this in an industry, in a world that is demanding that we need cleaner fuels or cleaner forms of energy?
Well, speaking of demand, Wirth did say, quote, we're still seeing real strength in demand despite international air travel and Chinese consumption not yet back to their pre-pandemic levels. Quote, demand in our industry tends to move faster than supply in both directions. We saw that in 2020, and we're seeing that today.
Yeah, you're not going to wrap up production unless you know that demand is going to be sustainable and last. And that air travel international mirrors what we just heard from our own George Ferguson. You're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Fewer than 13 minutes until the closing bell. The equity market right now very near the worst level of the day. We had a very strong employment report for the month of May, above forecast, and it's reinforced this view that the Fed is going to need to remain aggressive in fighting inflation. Non-farm payrolls up by 390,000. The unemployment rate unchanged at 3.6%. You know, even before today's report, the Fed was expected to raise rates by 50 basis points at the next two meetings. Well, now, market-derived probability for a third rate hike of that magnitude, 50 basis points, in September, it's around 85%. And we heard today from the head of the Cleveland Fed, Loretta Mester. She is saying she would back a 50 basis point hike in September if inflation is not retreating. We have the Dow Industrial Average right now weaker by about 1.1%, the S&P down 1.7%, NASDAQ comp is off about a little more than 2.5%. Novavax shares being hard hit, stocks down 20%. U.S. regulators have raised concern over the company's much-anticipated COVID vaccine. Briefing documents released today by the FDA show some, or at least note some, heart risk with this vaccine. Now, next Tuesday, the FDA advisors will meet, and the agency will at that time consider whether or not to grant Novavax's vaccine emergency use authorization. A move up in yields across the curve today, a 10-year Treasury now at 2.95%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
President Biden recently tightened sanctions on Russia another notch, pushing the country closer to defaulting on its debts. Keeping up this pressure on Russian President Vladimir Putin is justified, but a default wouldn't be the game changer some hope. Russia has been working hard to maintain its debt payments, proving that Putin regards default as a blow to his credibility. Until recently, Russian officials had been able to exploit a sanctions loophole that allowed debt payments to be made, but the U.S. has since closed this channel. Still, while an outright default would harm Putin standing at home, it wouldn't change his thinking on Ukraine. To end the war, the U.S. and its allies should concentrate, above all, on curbing Russian energy exports. That remains Russia's main economic vulnerability, and is where the alliance should keep its focus. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, we've got just about 10 and a half minutes left in today's trading session, folks. We are getting ready to wrap up what's been a shortened trading week, although...
Is it done already?
I know, but it feels like kind of a month of trading. I don't know how you all are feeling. So let's get to it.
Yeah, Jonathan Waite is fund manager and senior equity analyst. He co-manages the Frost Growth Equity Fund at Frost Investment Advisors. He joins us on the phone from San Antonio, Texas. Jonathan, how are you?
Good. How you doing, Tim?
We're good. We're trying to make sense of everything that's happening. On the one hand, you got Elon Musk and Jamie Dimon and Jane Fraser, and the list goes on.
Makes sense. There's a prize
of companies,
at the end of that for
of companies warning us. Then we get this, hotter than expected jobs report earlier today that's kind of saying, wait a second, hiring's still firing on all cylinders. Help us make sense of it.
Well, I think at the end of the day, when everybody's throwing around the R word, recession, that it's important to note that there's a psychological element to it. That there's a thought that if somebody else has stopped hiring or freezing, or laying off people, that I got to do it too. And so there can be a little bit of a groupthink that could be detrimental to the economy. But for the time being, most of the numbers we've seen have been, fairly healthy, but maybe a few yellow flags of signs of things slowing a bit. So whether or not that, becomes worse or some full-blown recession remains to be seen.
What's interesting, too, is when everybody starts to freak out a little bit, is that our Gina Martin Adams, Jonathan, reminds us that we're not seeing an earnings recession. It's a moderation of expectations. Earnings still growing. The pace of that growth is slowing. And yes, the tone has certainly moderated. But she said margins are still rising, but analysts are reducing their expectations. That's kind of where we are. And I guess the question is, do things moderate to the point where there is no growth and we're recession and it's a lot more painful? How do you see it, and how do you make investment decisions based on that outlook?
Yeah, well, okay, so let's start with the first quarter. We're going to see a negative GDP. We already saw a negative GDP print. You know, the second quarter estimates keep moving down. The question, though, from here is what about the second half and into 2023? You know, 85% of investors think that a recession hits at least by the end of next year. So it's very much consensus already that we're going to have a recession somewhere in there. So, you know, where we shake out is we look at, you know, at a typical recession, you're going to see excesses, right? What are the excesses we're seeing this time? Well, it's monetary stimulus, it's fiscal stimulus. And both of those, they're taking the punch bowl away at the same time, just as things are starting to slow down. So, you know, we're a little cautious there. We think it'll be a rough go trying to get to that soft landing. It's not impossible, but it could be a little rough time to get there. You know, we are seeing a bit slowing down on the, you know, we did see a good job number, but we are seeing the tech companies freezing hiring, some job cuts. You know, we've seen credit spreads move up a bit. You know, we had a very brief yield curve inversion, consumer confidence going down a bit. So we're with some yellow flags that we're watching.
I want to jump in because you actually co-manage the Frost Growth Equity Fund, which year-to-date is down 21%, but we know everything's been largely beaten up here. 5 years, you are on average annually more than a 14% gain, putting you in the 77th percentile according to Bloomberg data. So you've done well. The names in your fund, though, read like a who's who, I feel like, of corporate America: Microsoft, Apple, Amazon, Alphabet, MasterCard, Visa, Home Depot.
Yes.
Do you regret some of those holdings? Do you hold on to them? Because, like, how do you think about some of these names now?
Well, let's put it into context, right? You've had several years of those leading the crew, you know, the entire market up. And so it was inevitable that value stocks would have their day again, right? And so we've seen that shift to out of a lot of those growth names this year. We've seen a move towards defensive names, especially in the second quarter. And so, like I said, the market zigs, it zags. There will be a time that, you know, Amazon will come back in favor, that, you know, Google and digital advertising will come back. So we feel like we have good names to own through the cycle. You know, we're long-term investors, and we like to own these names through, you know, as long as we feel like that there's that they have secular growth and strength, we're fine holding it through cyclical swings.
So you haven't gotten rid of any of them, pared back or anything?
We will trade around some of those names, but by and large, we've stuck with those names.
How are you thinking about Tesla? It's your 17th biggest holding, just under 2% of the portfolio. It's been all over the place lately.
Yeah, we're kind of underweight versus the bench and versus some of the peers. We own it, probably don't like it as much as some of those, but we do like the EV, that market. We do like where the mix of new autos is moving. He's a very controversial figure. I'm not going to argue with that.
You got that right.
He's got a lot on his plate right now.
You're talking about Elon Musk.
Yeah.
Okay. Just making sure.
Who else were you talking about? Who were you thinking about?
No, I'm just making, you know, he didn't say the name, so.
If you have new money to commit, where do you put it? And how patient do you have to be for it to show some kind of significant performance?
Oh, you put it in the growth stocks, baby.
Hey, wait a minute. I don't know you. You can't say that. Growth stocks. You put it in the growth. So.
Well, look, I think there's a time in which the growth stocks will come back, and growth has, you know, through various recessions, done well in sell downs where you get typical cyclical stocks will sell down even more in a drawdown. So there will be a scarcity of growth when you get GDP slowing down, and so you will eventually have people gravitating back to names that have like I said, a long-term secular growth story, and those are the names that we like to invest in.
10 seconds. When do you think those come back?
Look,
You can take 15 seconds.
The back half of this year, like I said, is going to be the Fed holds the keys. It's going to be path dependent on what they do. We think that at some point in time they're going to have to back off, and I think that once we get a clearer picture of what they're going to do, and frankly, once we get a little bit of bottom out of some of the frothiness in these high valuation stocks, then I think that's a great time to get back into growth stocks.
All right, we got to run. Jonathan, thanks so much. Jonathan Wade, he's Senior Equity Analyst at Frost Investment Advisors, joining us on the phone from San Antonio. Have a good weekend, baby. I'm just kidding. All right, everybody. I said it was a wacky Friday. It is time to head over to our TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast. We're joined right now by Carol Master and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube. Carol, explain what's going on.
All right, I'm smiling. I don't know. I have no idea what's going on. All I know is we asked our last guest, Jonathan Wade, over at Frost Investment Advisors, and I said, so where do you commit new money at this point? And he says, you put it in the growth stocks, baby. I mean, that's where he said.
Did he say baby?
He did.
He actually did. I
Baby?
told him I don't know him well enough for him to call me that. But anyway, that's what he said.
But, you know, I did follow up there because I asked him when they'll start to come back, and he said the back half of this year. He said the Fed really holds the keys, and at some point they're going to have to back off. And again, it's about clarity and seeing what the Fed is going to do. He wants to get a clearer picture of what they're going to do, and then that's the time to get back into growth stocks.
Meanwhile, I mean, we've seen once again on the day, big tech really pummeled. We'd started to see some reprieve for the likes of Amazon, the likes of Apple, and then today they both fall short. We, of course, have that stock split coming up next week. We have so much macro data to brace ourselves for, but also the micro has been really interesting with some of the earnings warnings and the dollar strength within Microsoft, for example, yesterday, Taylor.
And it's really interesting, Caroline, that you bring up tech. I know I mentioned this comment a little bit an hour ago. I'll bring it up again. The strategist over at B of A highlighting that all of this sort of tailwinds for technology are gone and that tech really underperforms in some of these stagflationary environments. So really seems, again, like some of that negative sentiment on tech hitting sort of the big major averages and some of those individual big tech stocks once again today.
Yeah, as a group, it's down 20% here on a year-to-date basis, third worst performing among the 11 S&P sectors. And if you actually sort of go just over the last 3 months here, it gets even worse for that sector here. As far as the day here, we're down on the day and on the week pretty much across the board with the Dow Jones Industrial Average going to finish the day down by about 1%. The S&P 500 down by 1.6%. The NASDAQ indices really taking the brunt of it today. The composite down about 2.5%. The NASDAQ 100 down by 2.7%. The Russell 2000, that's your relative outperformer on the day, believe it or not, but it's down by 0.1%.
All right, Romaine, my own version of the Bloomberg quiz. Best performing name in the S&P 500 in the past 4 days?
I don't know.
Salesforce, up 12%.
Oh, there you go. Thank you.
A little bit outperformance there. So it's interesting, right, Taylor? It just depends. A lot of fundamental stories kind of at play.
Yeah, but everything else, Carol, for our radio audiences, we do for some of the sector best performers, the sector worst performers, you're really struggling to find any green, at least for the day. You have that one lone sector up here in the green. Yes, it's energy. You're up an additional 1.4%, just on a tear so far this year. Clearly the best outperformer. Everything else, though, Carol, is very much in the red. So you're not even getting any of the big outperformers that are even in the green today. All the way down, Carol, really technology. Certainly at the bottom.
Yeah, and that's a good point. You know, it's funny. I was checking out earlier when I was picking up gainers. Twitter was up almost 3% at its highs. It still finished out with a gain, but just up about 0.6%. The news today clearing the U.S. antitrust review for Elon Musk's $44 billion deal. Largely expected. Did you miss that?
Well, it's $40 a share at Twitter.
I know.
Wow.
Okay.
Yeah, getting close.
We're
to that.
getting there, right?
Not quite.
Still subject to acceptance by Twitter shareholders, and there's some other regulatory reviews. But anyway, that's one of my gainers. Okta Inc. Am I saying it right?
Yeah, Okta.
Just checking. It was up as much as almost 19%. finishing the day was still with a 5% gain. It was top in the NASDAQ 100. First quarter results ahead of expectations. Company also raising its full year forecast. It is still down, though, more than 50% this year. BMO highlighting what it said were impressive revenue that beat those estimates. And then I wanted to mention, I talked earlier about biotech as a sector, certainly an outperformer today. Well, here's the reason why. Bristol Myers paying $4.1 billion for the developer of a drug for lung cancer. We're talking about Turning Point Therapies.
Yeah.
It was top in the Russell 2000. This stock was up 118%.
This is a big deal, yeah.
Well, the stock closed at 34 and change yesterday. 76 a share is what Bristol Myers is paying for it. And this is those big pharma, right, looking for what's the revenue generators going forward.
Yeah, and all those kinase inhibitors, which is what Turning Point makes, and we've actually seen a lot of activity in that merger space.
And it's also a cancer drug that's expected to launch next year, so the payoff, you're seeing it sooner.
118% on the day. Yeah, incredible.
Yeah.
Hey, let's talk about the flip side, the decliners. Tesla shares having their worst day in more than a month, down the most in 5 weeks on this job cut plan. Reuters, of course, reporting early that Elon Musk and Tesla plan to cut staff by about 10% and pause all hiring worldwide. We did get a follow-up report from the EV news site Electric, clarifying that Musk plans to cut 10% of salaried workers, so not contract workers. Musk did say in an internal email, according to Electric, I know, you know, there's a little bit of nuance.
I thought he was bringing everyone back to the office.
If they are not getting...
If you're producing cars.
So just 90% of them are coming back.
Yeah, exactly. Okay. Hey, we'll see. You know, he sometimes changes his mind too. He said the Tesla headcount would be reduced because Tesla has become overstaffed in many areas. That again, according to Electric. I want to talk about Amazon too, finishing the day down by more than 2.5%. A couple pieces of Amazon news to pay attention to. The company did say that consumer chief Dave Clark is resigning, possibly a casualty of a slowdown at the e-commerce business he ran. He's been there since 1999. The news actually not moving the stock lower. Also, Amazon splitting its shares 20-1 today. Monday will be the first trading day that happens. But interestingly enough, Amazon actually closing not as far down as the NASDAQ 100, which closed down 2.7%.
But so much for that run, right?
Yeah. Well, for now, we'll see. And then American Airlines finishing the day down by 7%. The company sent a regulatory filing that it expects revenue to move well above its original expectations for the current quarter. This as consumers come back to travel following the pandemic. We should know, we did speak to George Ferguson at Bloomberg Intelligence. He made the point earlier on our program that he's seeing deterioration in capacity. And it's not necessarily because they don't think there's, you know, they're having trouble actually finding employees. That's a good thing for the companies to say. But he thinks that these higher prices are actually deteriorating demand. So we are seeing some demand destruction, which is a concern.
Interesting. And of course, margins being hit for those airlines by things like jet fuel, Tim. And I look across at what is the story for oil, the underlying base of commodities, a sea of green when you look at commodities. And once again, a 6th straight weekly gain in oil. We're seeing WTI up more than 3%. We've crept our way back up to about 120 a barrel for WTI. We're seeing similar moves for Brent. And this is once again, we're more fearful of the supply side constraints. Finally, Europe taking that action against Russia and the like. We do worry about supply side and the inflationary pressure that has. Gas oil on the push higher. We see metals get a bid with iron ore on the upside. We overall see as well a story of dollar strength on the day, which usually is an arbiter of pain for the commodity spectrum. But we are seeing every currency pair basically lower against the US dollar today. We're seeing the Japanese yen weaker by 0.8%. You're seeing the British pound, all the celebrations of the Jubilee back of my home. We're still seeing the pound down by 0.6%, weaker as well, as so too is the Australian dollar. This is a story, of course, about the data being so strong in here in the United States, the labor data looking good, and it means the Federal Reserve has that platform to push back and indeed fight inflation, as the ECB might talk about in a little bit next week. And we see European bonds actually pushing on the downside, the yields pushing up on the week, Taylor.
Really good point, Caroline, when you think about some of the labor data, at least here in the U.S. as well, sort of filtering in through yields higher every single day this week because you've really good, strong, decent jobs data, right? And that's sort of giving the Federal Reserve that permission to keep moving at a relatively quick pace here. So overall for the week, you're looking at a 2-year yield that's migrated from a 247 to a 265, and really similar story here, Romaine, as well on a 10-year. You've gone from a 273 to a 294. So the path really has been yields higher for the week.
Yeah, and I think that could potentially continue. Who knows? But I think, you know, we talk about some of the data that we get next week, and obviously the big one's going to be that CPI report, really the last major economic report that we're going to get before the Fed goes into that meeting on June 14th, June 15th. And we know it's going to be hot. There's no doubt about that. The question really is now is whether the Fed sort of sees any sort of incentive to change what's already been telegraphed.
Well, and it's all about managing expectations, I guess, at this point, in terms of not surprising the markets. The Fed's been very good. There's been a lot of speakers out there. I do go back to Gina Martin-Adams talking about that we aren't in an earnings recession. You just got to keep in mind that the earnings growth is just not as strong as it used to be. Estimates certainly coming down when it comes to margins, but nonetheless, there's different types of recessions, and we'll see ultimately how this one plays out and how much the Fed impacts that.
Yeah, I think the focus now, it's much less on what the Fed does in June and July and much more about what the Fed does past that. And it's interesting to note from the Fed speakers that we've heard in recent days, we haven't really seen a change in expectations like we saw before the May meeting happen with regard to what we've heard from Fed speakers just recently. It's been pretty consistent since the last meeting.
Yeah, and indeed we see what the ECB goes on to say next week. We've got the inflation print that's going to be digested from the Federal Reserve next week. Overall, a lot to sort of be treading water on. I'm still just wondering when volumes are going to come back as well. This has been such a light week. Yes, it's been a holiday shortened one. Is that because we're in the summer doldrums? Is it because we lack conviction? And where on earth this market's going to go at the moment?
I don't know. I mean, the funny thing is, Tuesday the volume was actually higher than at least the year-to-date average and the one-year average as well. So there were a lot of people who came back to work on Tuesday and are clearly willing to swap shares, but it just kind of tailed off on Wednesday, Thursday, and then Friday, just an absolute low volume day today.
I think we are beginning to see Friday summer doldrums take place, Carol.
All right, so what's going to happen with Jamie Dimon next week? First, we got storm clouds, then we got a hurricane. Where do we go from there? Tsunami?
Monsoon.
Oh, Jinx. Buy me a Coke.
Whoa, mind meld,
Wow.
mind meld.
Wow.
That's it. We're done.
What a
We're
way
done.
what a way to end the week.
Go have your wine. We'll come and see you in a minute.
All right, that's going to do it for our cross-platform coverage on radio, TV, and YouTube. We call it Beyond the Bell. We'll see you again, same time, same place on Monday.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I'm ready for ice cream and some wine. How about you?
I can help you with the wine.
The ice cream, do we miss it?
I think you missed the ice
Sarah,
cream.
do we miss it? The ice cream's
Oh,
done?
there's definitely no more ice cream left. I think they take that away. So on
She had a
Fridays here at
great-
Bloomberg, we're very lucky. Summer Fridays, we
We're
have ice
spoiled
cream
here
and
at this company.
popsicles.
Yeah.
I highly recommend that every company do this.
Yeah, ice cream for kids. It just makes us happier. It's so easy. We don't accept, well, I don't know. Maybe we're not so easy. All right, let's get back. Let's get back to world and national news. On it for us on this Friday is our own Denise Pellegrini. Hey, Denise.
All right, thank you, Carol. And even during the work from home days, I always had ice cream on Friday just on my own.
Nice.
Kind of couldn't get it out of my head. Former White House official Peter Navarro. He's been indicted on charges of contempt of Congress. That's after he defied a subpoena from the House panel investigating the January 6 attack on the Capitol last year. Mick Mulvaney, he's former acting White House chief of staff for President Trump. He's highly critical of what Navarro is doing.
You don't get to sit on the outside and say, well, this is a political stunt. I don't have to go. That's for the politicians to make that argument. That's not for the private citizens. And Peter Navarro, I think, as he's finding out, Peter always thought he was smarter than everybody else. I think we're going to find out if it's right or not.
And Mulvaney there with David Weston on Bloomberg Balanced Power. The January 6th committee kicks off primetime hearings on what happened next week. The number of U.S. monkeypox cases is up to 20, and Dr. Daniel Karitz of Brigham and Women's Hospital says it's important to remember we do have a monkeypox vaccine and effective antiviral medications as well.
Unusual to have such an infection. The last outbreak in the United States was in 2003, where about 70 people contracted that.
And the government has begun shipping drugs and vaccines to 8 states that requested them. New York lawmakers have passed a package of bills tightening gun control access across New York. Governor Kathy Hochul is expected to sign those bills. And China's defense ministry is requesting a meeting with Secretary of Defense Lloyd Austin during his planned visit to Asia next week. The Pentagon is discussing potential times for that meeting, and they might talk about potential guardrails for managing the military relationship between the two countries. Global News 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
All right. Should we do this?
Yeah, let's do it.
All right. It's Tim Stenovic and Carol
Shonali
Massa. We're
Bostic
live.
does a story in the Bloomberg, and you got to read it.
Oh, I know. This is among the most read. Shout out to our colleague, Shonali Bostic. You know her from Bloomberg TV and Bloomberg News. This story about a black swan investor watching for the, quote, greatest credit bubble to pop.
His name is Mark Spitznagel, and we're hopefully saying it correctly.
I think that's right.
Is paid to be prepared for when the market's weakest links are exposed in a big way. Right now, the Universa Investments founder, whose fund aims to protect clients during black swan events, says the financial system is most vulnerable to, quote, the greatest credit bubble of human history.
Okay, so here's what he said in an interview with Sonali Basak yesterday. Quote, if this credit bubble ever pops, it's going to be the most catastrophic market failure that anyone has ever read about, but let's hope that doesn't happen. He said, quote, we've gotten ourselves into a tough spot.
He insists he's not a doom and gloomer. He's long been critical of central banks keeping interest rates near zero or even negative, which he says has really propped up asset values and encouraged excessive borrowing. Officials around the world are now tightening monetary policy to combat elevated inflation. His warnings, though, to be fair, follow some other cautious remarks this week from JP Morgan Chase CEO Jamie Dimon, who told investors to get ready for an economic hurricane, although, as Larry Fink of BlackRock said, that's one scenario. He didn't say it was definite. And then Goldman Sachs President John Waldron, who said he's seen an unprecedented number of shocks and expects, quote, tougher economic times ahead. I feel like that's the consensus from a lot of folks right now.
Yeah, it is. It comes at a time when hedge funds like Tiger Global Management from Chase Coleman are caught in the middle of a rout in tech stocks. Gabe Plotkin's Melvin Capital Management is shuttering after a string of losses. Spitznagel reiterated that his criticisms of the industry at large.
Universa, by the way, founded in 2007, so right at the financial crisis, and advised by Nassim Taleb's, is a hedge fund in the purest sense, specializing in risk mitigation. It aims to protect against the biggest market crashes by preserving capital of those periods. I'm looking for performance, but I don't see it in this story.
It told clients its options trades returned 3,600% in March of 2020. That's according to a letter obtained by Bloomberg at the time.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
And it's brought to you by Informatica. In the cloud, your data has the power to do the extraordinary. Manage data across any location in the cloud for accurate and actionable insights. More at Informatica.com. We're at 17 past the hour right now. This is Bloomberg Business Week, and here's your data check. We were down today across the board in the equity market, and the culprit is a strong jobs report that seemed to clear the way for the Fed to remain aggressive in fighting inflation. Overall, non-farm payroll growth last month, 390,000. The unemployment rate remains unchanged. You know, even before the data, the Fed was seen raising rates at the next two meetings. That would be June and July by 50 basis points. And now the market seems to be saying the probability is 85% we're going to get a third rate hike of that same magnitude, 50 basis points in September. Today we heard from Cleveland Fed Bank President Loretta Mester saying she would back a 50 basis point hike in September if inflation is not retreating. In the minus column today, Tesla stock was down more than 9%. Word was that, is that the CEO Elon Musk emailed staff and indicated Tesla will need to cut 10% of its salaried workers. Dow Industrial Average weaker by 1%. The S&P today down 1.6%. NASDAQ Composite off 2.5%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Doug, you tapping into that ice cream on Fridays?
I don't have a moment to breathe.
I will get you next Friday,
just
Doug.
tell
I will
us.
bring you an ice cream. You tell me what you want. Do you want a
all good.
popsicle, chocolate, vanilla? What's up?
Whatever you need, okay? All right, Doug Krisner there with an update on the markets and today's top business stories. Hey, certainly one of the big business stories of 2021 was that record round of M&A deals last year. And at the end of last year, bankers were telling Bloomberg there were no signs of slowing. And then, of course, 2022 happened, bringing in it with it lots of financial market volatility and different macro values and outlooks. And yet, we are still seeing deals getting announced and getting done, Tim.
Let's get into it with Chris Blum. He's the head of leveraged finance at BNP Paribas. He joins us on the phone from Massachusetts. Chris, how are you?
I'm good, thanks. How are you?
We're doing well. So exactly a month ago, the three of us were at the Milken Institute Global Conference. You participated in the panel on global M&A about chasing records. A lot has changed in the markets just in the last month. Give us an update from an M&A perspective and what you're seeing.
Yeah, no, it's a great topic, and I think that the panel that we had out there was actually, very, very interesting in terms of the outlook for the rest of 2022. I think we talked about that, we had quite a bit of agreement that we thought the market might rebound as we headed into the back half of the year. We have seen transactions still getting announced, and really, I think the big thing that we need to look at is volatility. At the end of the day, in order to actually agree on valuations for assets, you need to see volatility mitigate. You need to see the credit markets then stabilize so that the cost of capital, becomes known as companies look to bid on assets or sponsors look to bid on assets. So I think that as we see volatility continuing to be relatively high in the equity markets and the debt markets, it makes it harder. But we are seeing deals, begin to be announced again. Albeit, definitely not at the pace probably would have thought.
Are they different types of deals, though? From the perspective that everybody says to keep an eye on, our own M&A reporters here say keep an eye on private equity right now because that's where you're going to be seeing a lot of deals. Are you seeing a different type of deal in this environment?
We are. And again, the core part of my job is running our financial sponsor business and our leveraged finance business. So we have seen, private equity investors love downturns in the equity markets because it creates opportunity from a valuation perspective. And while the cost of capital has gone up quite a bit when you see interest rates rising like this, at the end of the day, especially if you're looking at sectors like tech or healthcare, while those valuations have gone down, when you're trading at 15, 20 times EBITDA, financing at 6 to 7, maybe it's 6 times now versus was 7 times before because of that higher pricing on the debt. That's not necessarily making that investment decision. So the downtick in valuations does create opportunities for PE shops in order to take businesses private. So I think we're seeing a little bit more of that.
So, okay, are we on track for another record year, or that's not likely?
definitely not going. I don't think it's going to be another record year. I mean, you are seeing some, large cap M&A being announced. You saw Broadcom announce a very large transaction recently. However, the just the volatility in the markets, I would say it's continued. I think we all were talking, exactly a month ago, beginning of May. That's continued. We're in early June. Volumes are down in both debt and equities. So I think, I would say a record year, no. Will the year round out, with a solid back half? That is definitely still possible.
How do you watch the VIX, Chris? Because, we have some of our reporters and even the New York Stock Exchange president referring to certain levels of the VIX as a point when you'll see M&A or IPOs.
Yeah, no, it's a great question. So I think when you're over 30, it's very difficult to see any type of transactions in the financing markets, as well as any type of settling out in M&A. When you're below 20, I think that makes things feasible. Right now, we were over 30 for during the period where we had very heavy equity market volatility a week and a half ago. You were over 30 for a few days. We're now sitting at 25, 26 for the last few days.
Right.
If you see a dip back below 20, I think a lot of things become more possible.
Interesting.
We've seen the high yield bond market open up just this week. We had a $4.7 billion day on Wednesday. There was just $5 billion printed the entire month of May.
Yeah, so very different, very different. Hey, one thing I want to ask, so are you not busy on the weekends? Are you and your team not busy on the weekends?
we are definitely busy on the weekends. Just in terms of, look, we've all got risk portfolios that we're managing, and there are deals in the pipeline. There were I saw an article today talking about the fact that, we've got roughly $30 billion of sort of debt financings in the LBO market that needs to come in the next couple months. So, we're always looking at the positions that we have on and the commitments that we have on.
Right.
And if we need anything else, we've always got Elon Musk to send something out that'll keep us all running around.
There it is.
Having said that, if you had to pick an area where you think we will see a more active area of deal flow, is it some of those beaten down sectors? Is it health? Is it what? Just quickly.
I think you're going to see healthcare and tech continue to be areas of opportunity because you can get outside returns as a private equity firm because of the growth in those sectors, by putting to work a very large amount of equity. So, the equity checks in those deals are usually a high percentage of the capitalization.
Right.
And so you can put a lot of money to work there. I think that you'll see industrials will become more and more interesting because, at the end of the day, businesses with good hard assets, when you see sort of the high
right.
sort of valued assets kind of trading down,
yep.
Businesses with good hard assets could be attractive.
Got it.
And power and energy.
We got to run. Chris, have a great weekend. Chris Blum over at BNP Paribas joining us right here on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. It's been an interesting week, and some senior execs from well-known tech companies leaving. Of course, we talked about Sheryl Sandberg earlier this week, and then a key one at Amazon.
Yeah, Dave Clark. He's CEO of Worldwide Consumer.
Or is he a key one? That's what we have to ask Brad Stone.
Stock didn't move on this, which was interesting.
It's down 2.5% today.
It is, but I mean, the NASDAQ 100 is down 2.7.
Right, it was down like all day. All right, we'll see what Brad has to say in just a moment. First up, though, let's get back to your top business stories that trading day. Here's once again Doug Krisner.
Well, you know, now that the day is officially over, and so far as trading is concerned, that official 20-for-1 stock split, the Amazon split, is in effect, and trading on Monday will begin to reflect that on a split-adjusted basis. We were down today across the board in terms of equity price action. That strong jobs report essentially clearing the way for the Fed to remain very aggressive in fighting inflation. Non-farm payrolls up 290,000. The unemployment rate remains unchanged at 3.6%. So the net effect moves interest rates across the U.S. curve higher. 10-year Treasury last quoted at around 2.93%. We were up by more than 3 basis points on the day. At the shorter end, the 2-year higher by 2 basis points to 2.65. The equities look like this, with the Dow losing more than 1%. The S&P 500 down 1.6%. NASDAQ comp weaker by about 2.5% today. Consumer discretionary, the one group most severely hit. Tesla shares leading this decline. The stock was off 9% on word Elon Musk emailed staff and indicated that Tesla would need to reduce salary workers by about 10%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Well, we are going to talk about Amazon. So much for that 7-day winning streak where shares of Amazon were up about 20%. Stock down today. And to be fair, as Tim mentioned, the overall tech trade was down, but we did get some news.
Yeah, we got news that the consumer chief is exiting. This is Andy Jassy, the company's CEO, hinting at more change. Joining us now is Brad Stone, Senior Executive Editor of Global Tech here at Bloomberg News. He's also the author of a couple really good books on Amazon, most recently Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. Brad, good to have you with us. So Dave Clark has been at Amazon since 1999. I think it's fair to call him pretty much a lifer. He joined right after getting his MBA. Were you surprised at this announcement?
I was, Tim, and I think actually his contribution to the company is so significant, maybe shareholders should be reacting a little more forcefully to today's
Interesting.
news. I was surprised because he's only been in this new role as CEO of retail for less than 2 years. And before that, he ran the logistics division. He's really the guy that architected the Amazon supply chain as we know it today. So that is the hundreds and hundreds of warehouses, all of the trucks you see on the highways, the Prime Air, he ginned that up in the last couple of years, and then all the vans and the Amazon uniformed workers who are delivering packages to our homes every day. It's an immensely complicated network, and he is really one of the few people who probably understand it intimately, and so the fact that he is leaving is probably kind of frightening for some people who know the company well.
So why is he leaving? What do we know?
You know, we don't know. My colleagues Spencer Soper and Matt Day wrote a good story that's out now that suggests that maybe there's a little tension with Andy Jassy, the CEO of the company. Under Jeff Bezos, executives like Dave Clark and Andy Jassy, when he ran AWS, had a lot of autonomy. Dave Clark basically ran the supply chain division by himself. Jassy ran AWS by himself, but Jassy's a micromanager. He likes to get into the details. And our sense is that he was maybe perched on Dave Clark's shoulder in a way that Clark wasn't entirely comfortable with. But we should also say that Dave Clark says in his tweet that he wants to return to kind of entrepreneurial pursuits. He said it's ready to build things.
Wait, haven't I heard
this? After
this?
23 years at Amazon?
Wait, haven't I heard this before, too? Didn't I hear this with Sheryl Sandberg?
It's the new, I want to spend more time with my family.
It is.
What was Clark? Yeah, go ahead.
Yeah. Well, I was just going to say that it wouldn't surprise me if he was to jump to something a little smaller. But we'll see.
Well, there's plenty of things out there that are smaller than Amazon, but given how much he earned in the last couple of years, in the tens of millions of dollars, and plus what he's earned in stock at the company, not necessarily in any hurry, I would imagine. What was Dave Clark like to work for?
Yeah, it's interesting. Tim, I have a whole chapter in my book.
I know.
now I'm going to have to update it. He's a difficult boss. He's a demanding boss. He started in the warehouses way back in 1999. He started managing warehouses and then ran all of the East Coast for a couple of years, and then went back to Seattle and was running the whole North American supply chain before he took it all over. He was given a nickname that sort of, I think, answers the question. The nickname was the Sniper. And the idea was that he had a real eye for underperforming workers and could be pretty relentless or remorseless for when it comes to underachievers. And so, he was seen as a challenging guy.
Is it fair to say that the warehouse division that he's been the CEO of this year has underachieved?
I would say it made a tactical blunder. And the blunder is actually more complicated than I think it gets conveyed. It's seen as like an overreaction to pandemic growth, and they grew too much. But at the same time, Amazon was also fulfilling a directive from the previous CEO, Jeff Bezos, to support one-day or same-day delivery and to make that more rapid delivery promise a part of Prime. So they were in the midst of this major expansion, and then the pandemic, quote unquote, ended, even though we're all still getting COVID, and demand fell. And so so Amazon said pretty explicitly in the last quarterly earnings report that we made a mistake. And you don't often hear Amazon say that. It was almost like they kind of threw Dave Clark and his division under the bus.
Hey, Brad, just got about a minute left here. I do wonder, the tech sector, the overall equity market's been under pressure. It's been a tough, volatile market year. Tech, though, big tech in particular, which has just been on fire, is really seeing a lot of pressure, including a name like Amazon, still down about 27% so far this year. I think about Meta and Sheryl Sandberg, and I understand I want to spend more time with my family kind of thing. I get it. After you've been at one of these companies for a while, it's got to be a lot of work. But I do wonder if the stocks were doing well, would we be hearing these senior execs leave? And forgive me, I've only got about 35, 40 seconds.
Yeah, it's interesting. I think like in maybe both of these cases, the executives were looking for ways to get out. Sheryl had been there for a long time, obviously an early employee, not much left to prove, and by all accounts had already been sort of disengaged. I don't know, but certainly the noise and the fun quotient of the job is getting lower in this economic environment.
Yeah, it's got to be tough. Which reminds me, the double issue of Bloomberg Business Week, which is out on newsstands right now, it's the tech issue, and so you can really get a great read on the overall sector and so many specific stories. Our thanks, as always, to our Bloomberg Senior Executive Editor of Global Technology, Brad Stone. Check out his book. He's written several on Amazon, including The Everything Store and Amazon Unbound. This is Bloomberg Radio.
Let's get a check of the latest world and national news with Denise Pellegrini in our New York newsroom. Hey, Denise.
Hey, Tim. And former White House official Peter Navarro has been indicted on contempt of Congress. That's after he defied a subpoena from the House panel investigating the January 6th attack on the Capitol. And we asked Mick Mulvaney, former acting White House chief of staff for then President Trump, if Navarro has something to hide.
Is it possible with Peter? Sure. Peter, I always thought Peter was a loose cannon and capable of saying and doing anything. In fact, I've been extraordinarily critical of the staff, including my successor, Mark Meadows, in what they must have been allowing the president to hear, what they must have been saying to the president in the weeks and the months after the election.
And Mulvaney also telling David Weston on Bloomberg Balanced Power that Navarro gave Trump some of the craziest advice he'd ever heard. Number of monkeypox cases in the U.S. is up to 20. Dr. Thomas Facetta at the Temple University Medical School in Philadelphia says the disease could be hard to track.
The disease can be present in the body without a rash.
And 8 states have asked the federal government for vaccines. Watch for a wave of COVID in southern states this summer, according to Dr. Ashish Jha, coordinator of the White House COVID-19 response.
Really worried about what we're going to see with elderly people in the South this summer. And so we've got to really push hard on boosters, first boosters really, for older Americans in the South.
And Shah at a medical gathering in San Francisco. And you were talking about retail a minute ago with Brad Stone. Well, you might be able to get some good bargains, even as we talk about inflation, because Walmart says it'll be a couple of quarters before it reduces its inventory glut. And this means watch for sales, especially in larger items at stores, things like refrigerators that are expensive to store. I'm Denise Pellegrini. This is Bloomberg.
Thank you so much, Denise Pellegrini. You listen to Bloomberg Business Week. Carol Massar, Tim Stonovic, here in our Interactive Brokers studio. I've had my banana snack.
Yeah, it's past 4:11. You're allowed to do that.
That's what we do around here. That's how we roll.
There's an election coming up.
There is. So let's talk about it.
Yeah, a wave of brazen crimes targeting the wealthy in Los Angeles has spooked many residents. The spate of daylight robberies, murders, and follow home assaults is upending the mayor's race in one of America's most progressive cities. Do you know what a follow home assault is?
No.
Do you remember I had dinner when we were at Milk, and I had dinner with one of my friends in LA? We were driving through Beverly Hills, and he was telling me about these follow home assaults that are happening. Somebody will follow a car, a wealthy couple home from a nice restaurant to their home and rob them at their home.
Oh my God.
And that's something that's been happening in the LA area.
God, that's terrifying. Yeah. Rick Caruso, a billionaire developer with a tough on crime stance, has leapt to pole position in the June 7th primary ahead of Karen Bass, a longtime Democratic congresswoman and community activist. The uptick in lawlessness is also driving well-heeled Angelenos to seek specialized services, panic rooms, armored luxury cars, and firms that scrub websites of personal information that robbers could use. Don't you remember, too, that it used to be like you list on Craigslist and you say, okay, you do a deal with somebody, and they would be like, well, you can't come pick it up then. I'm not going to be home then. And then people would rob, you, like, we had stories in our neighborhood of stuff like that going on. It's like you have to be so careful because there's so much socially your footprint that you can be tracking.
Right. The list of these sensational crimes, it's continued to grow over the past year, Carol. A lunchtime robbery at a Beverly Hills restaurant left one woman shot and a man's $500,000 watch stolen. A man taking out garbage in Studio City was attacked by a group who zip-tied his disabled son and ransacked his home. Airbnb guests in Beverly crested $75,000 of cash, jewelry, and other items stolen after thieves trailed them to their rental house. My friend's car was stolen. She lives in Studio City.
One of the housewives of Beverly Hills was also broken into.
I didn't know about that one.
She was in the bed. It was like she was scared.
Yeah.
All right. I'm just saying, it's a lot of stuff happening. All right, you're listening to Bloomberg Business Week. Carol Massar, Tim Stonovic. This is Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It was a down day for the equity market, and we finished just off the worst level of the day. I'm looking at crude oil prices now trade above $120 a barrel in the extended session. So this will make for a sixth straight week of gains for the crude market. Yesterday, you'll recall OPEC Plus delivered a modest increase in output, and that really failed to reduce concern over a widening supply deficit. Today, gasoline prices hit a new record. In fact, energy tracked the price of crude oil higher, and when I say energy, I'm talking about the equity side now. And in a matter, if you look at the S&P 500, energy was the only positive group within the 11 industry groups within the broader market. S&P today down today by 1.6%. The Dow weaker by 1%, and the NASDAQ composite was off about 2.5% today. We've been talking a lot about the story on Tesla. Stock down 9% today on word Elon Musk emailed staff and indicated Tesla needs to reduce salaried workers by 10%. The email indicates that Tesla became essentially overstaffed in some areas. Interestingly, hourly employees will be expanded. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. Very rough week, another one. So we're going to shift gears for you all a little bit as we wrap up our week here on Bloomberg Business Week. Brett Barish is founder and CEO at Sovereign Brands, a family-owned wine and spirits company. He's joining us via Zoom in Connecticut, and it is really great to have you here. Although I've got to say, it would be even better.
What's going to happen? What are you going to say, Carol?
If we were all together and we were sharing a glass of McQueen in the Violet Fog, it would be a lot sweeter. That's all I'm going to say.
When's it going to happen, Brett?
How are you?
Yeah, well, for me, it already started. I'm drinking.
Well, that makes one of us.
Yeah, well, I can drink for the three of us, so it's even easier.
Well, happy Friday.
Well, talk to us about the business, because I think, we cover a lot. We talk with a lot in the wine industry, with the spirits industry. Talk to us about, we saw a lot of buying during the pandemic. So where are we in terms of the business right now, pre-pandemic levels today? And I'm curious about what kind of supply chain difficulties you might have, if any.
Business was pretty wild during COVID, just because it was changing in consumer habits and with the shutting down of bars and restaurants and consumers going to stores. I think what you're now seeing is there's life back in the streets. I was talking to, not just in the U.S., but everywhere. I was talking to one of our colleagues in the U.K., and they're celebrating the Queen's Jubileum, and it's the most vibrant it's ever been right now.
Wow!
So you're almost seeing a tilt back to the center, hopefully, and that's everyone's goal.
Brett, how are your costs? How are your input costs? Supply chain stuff, challenges getting ingredients, paying employees to attract and retain them.
It's Tim. Everything's gone up.
How much?
There's no question, and I think it all started. It's a global issue, and it all started with once that chain stops, there's pent up. All of a sudden, there's so much demand, and now we're all playing catch up. So we went months and months without inventory, and because we just couldn't get it, and then we're ordering more and more so we can play catch up for the future. So we personally, on our side, with our brands Bel Air, Bumbu, McQueen, and our new brand Vion, now we're in a good position because we've overordered, if that makes sense.
No, we've actually heard that from a lot of the retailers where they did because their inventory levels were up because they were over ordering to make sure that they had what they needed for their consumers. So based on what you're seeing, what kind of feel do you have on the economic outlook? And I do feel like to some extent alcohol might be a little bit recession-proof, but that's not true. Like when you're spending $90, $100 to fill up your tank, you might not have as much money to spend on some other things. So how do you see it?
Yeah, I think, when I think back to 2006 and 7, I think there's always going to be, when people talk about recession, it's basically you're trading down in some cases, you maybe were drinking, you'll continue to drink, but maybe you'll trade down to something else. So I can see that happening, but for us, I don't know. I think this is one of the reasons why I love our industry is, it is true. In good times, people drink. In bad times, people drink. So It's a very, very resilient industry.
So what
and it continues to prove it.
What are people drinking? What do they like most of all?
Just my brands.
No, that's not true. Brett, sorry. No, but really, like, is it gins? Is it rums? Is it, we talk to people in the brewery business. Like, what do you think? What are you getting? And who is your demo? I'm curious too.
Well, you're asking the wrong person because I'm not a trend follower.
Okay.
We like to build on my side. We like to build brands that and we do it based on no advertising, where it's that organic brand building. It's almost like when a TV show is hot on Netflix or Hulu and they're not advertising, people are just talking about it.
Mm-hmm.
So to me, our brands do well, but they're in different categories. So my Bel Air brand is in the champagne sparkling category. It's now the #1 brand in the United States. Our rum, Bamboo, that's hot. That's the #1 premium rum and the fastest growing. That's a great segment for us.
Yeah.
But as an example, Carol, when we launched that brand, everyone told us don't do it because it's not hot. So I just don't like to follow trends. So we like to do what we're doing.
I'm wondering about more of your history here, because years ago you sold Ace of Spades to Jay-Z. When do you know to sell a brand versus to keep holding on to it and to continue to build it?
Good question.
Well, I think it all depends on the situation. So in my case, I didn't have any money. And
that's a good answer.
And I had lots of ideas and no money. And it was the most difficult decision I could ever make in my life. It's like selling a child. But what it did is it made us bigger and stronger. And now I get to do these other brands. So I think everyone's position's different. And the reason you do it and why. For me, it gave me capital to do all these other brands. My team has grown 6-fold, 7-fold. We're in 100+ countries, so it's the way I get up the ladder. It's allowed me to get up the ladder.
Are you always thinking about, though, Brett, of developing a brand, cultivating it, and then eventually selling it off, or that's not necessarily the end game always?
No, it's funny, and maybe it comes from just a reality check. I get those presentations that for a pitch book on a brand, and in 5 years, if I can get 1% or 2% of the category and there's a multiple of X, and I'll sell it. I was that guy 20+ years ago, and if you're thinking like that, to me, brand building never works. It just doesn't work that way. You got to be patient. You got to be long term. I don't think like that. If it happens, it happens. But to me, it's you're thinking too narrow. And to me, I've learned my lesson. It's not about the money. It's about building something special, and good things come when you think like that.
How do you compete as a small player, relatively small player, for shelf space and for the distribution? Just in the last minute that we have with you,
it's everything, Tim. It's everything from we got to work harder. We got to be different. We got to be more creative. We got to constantly try to reinvent ourselves. I've got this brand Bamboo, which, as I said, is our rum. We have more followers on Instagram than Captain Morgan and Bacardi, and they have hundreds of millions of dollars in advertising.
That's hard to do, though.
But it shows. Yeah. I'm the example of you work real hard, you put everything into it, and you can get there. And just the key is don't compete with them the way they do business, because you can't. You got to compete when you do business, and then you can.
Well, bottoms up. Next time, come in studio, and next time, bring a bottle, and we'll talk a little bit more with you.
There's 2 of us.
I'll bring 3. Cheers, everybody.
Cheers. Brett, have a good weekend. Brett Barish, she's founder and CEO at Sovereign Brands, joining us via Zoom in Connecticut. Great way to wrap up this week.
Yeah, I like doing the alcohol thing on the, close to 5 o'clock on Fridays.
It's 5 o'clock somewhere.
It is, and here it's close to it.
Check out our weekend show, 8 a.m., Bloomberg Radio, and also you can find it on our podcast feed. For Tim Stenevec and the whole Bloomberg Business Week team, have a safe evening and weekend.